why we think we were, going, higher in rates there. But look, if you have a balanced portfolio and you have a risk managed portfolio, you should be able to weather the storm as long as you stay invested.
But John, my sense is a lot of investors out there now, after what we've been through over the past several years, don't really have a traditionally balanced portfolio, and we're feeling a little bit naked over the past week. And now, if they didn't sell, maybe they're in a position to do something, but they might be frozen. How do you balance at this point?
Well, I think, number one, it's never good to sell in a panic situation, as we know. You miss the days like today. If you miss today, if you sold yesterday, you're really, really upset. So you got to stay invested. Next, you start adjusting in things that are better risk managed, that can take care of the downside. Traditionally, we're the largest convertible bond holder in the United States in terms of our funds, because it helps on the downside. You may get a little cut on the upside, but the downside. We have products, and a lot of the houses do, but we are great risk managers and great options traders. We brought out 100% protected Bitcoin from the downside. You can get exposure to the upside, but be protected on the downside. So people are really taking to these products because of the volatile markets. And believe me, these markets are going to continue to be volatile. We have a 90-day pause. That uncertainty is the biggest reason for volatility. And we've taken a breath today. We're all pretty happy that things came back, but the uncertainty has not gone away, and it won't go away for a while. So we have to get this whole tariff situation done, and also we need to pass the tax cuts.
So how should investors treat risk, particularly during this 90-day period? Retail investors have been piling into leveraged ETFs, been doing a bunch of margin trading. Is there a ceiling, you think, on risk assets from here? Is there particular danger in the volatility given how high the VIX still is, even after coming down today?
There are products out there to help mitigate that risk. And that's what clients should be looking at. They're market neutral funds. Ours is one of the largest in the world, where markets are up, markets are down. You're getting a particular yield because it's an arbitrage fund that deals with risk management. It's not sexy. People are used to getting double-digit yields the last couple of years. We're spoiled with equity yields being really high, much higher than the average of their existence. But people need to understand that that's not normal. And so they should have a certain amount of their portfolio in products that can avoid some of the risk. Market neutral type funds, not the leveraged type of ETFs, but the other types of ETFs that mitigate your downside risk is really, really, really important. Staying in cash and looking at opportunities of stuff that is still cheap out there and dipping your toe back into the market is clearly, one way to handle this.
John, what about international? Should investors look there if they don't have much?
Absolutely. I mean, international, there's going to be, look, today was telling as to who was excluded from the 90-day pause, right? And so this is, a war, a tariff war, or as I called it before in other programs, a yield war with China. And we need to look at that separately, and then the rest of the world differently. So there are pockets of the world that things are going to go much smoother. Trade is going to be really, well, and they're going to flourish as well as we are once we get through this pain. There's going to be pain. The administration talked about it. We've seen it. We felt it. John, everybody wants to go to heaven, but nobody wants to die, right? And so that's something that people need to understand. There's going to be more volatility. They need to put themselves in products that are risk managed by professionals, and I think, just go lever up on everything.
Yeah.
That's hedge funds got hurt. Just this, early in the morning, I couldn't sleep because they were unwinding they got all their limits on the things, and so when you're levered this high and it goes against you, it's not a good look.
I think a lot of investors saw a bright light this week, even if they didn't die. John Kadunas from Cosmos, thank you.
Thank you.
Well, speaking of some stunning moves for tech shares today, check out the biggest winner in the NASDAQ 100. Microchip, MicroStrategy, or just strategy, if you will, ARM and AMD all up more than 22%, and Apple jumping as well, as I mentioned, after the tariff news, even though higher tariffs are still on China at 125%. Steve Kovac covers Apple for us here with me. Steve, we've traditionally thought about China as being the place where Apple manufactures iPhones via Foxconn, et cetera. They've moved some to India as well. Right. But why do you think this excitement about this announcement when China is still under the gun?
That's exactly right, and that's exactly my thought as well. When this first happened, I mean, good news for Apple, right? They can, as we've been hearing some reports of, divert some of their production to India, bring those iPhones over to the United States, but they're not out of the woods yet. China, these 100+% tariffs are really going to hit them still. I'll go back to what Wamsi Mohan of Bank of America said earlier this week in his note that, or sorry, to the Wall Street Journal rather. He told them that even if Apple ships every single iPhone they make in India to the United States, it would only fulfill 50% of the demand that we have here. That means China is where the rest of them are going to come from. And by the way, they're not going to ship every single iPhone from India over there. So they still have to grapple with that, what's going on there in China. By the way, we know we got to wake up tomorrow morning and see what the retaliation is from China. We've been waking up every morning this week and seeing something. And beyond just more tariffs being levied on the United States, do they go after them on antitrust grounds? Do they go after them? Do they slow down the supply chain? There are so many other levers that China can pull to kind of squeeze Apple. And then you might be saying, okay, well, why, the whole notion of these tariffs, right? Bring manufacturing back to the United States. Let's start building iPhones here in the United States. MAGA, let's go, let's do it. But I mean, that is what's being said, right? Yeah. That's what's being said by this White House. I'll go back to Mr. Mohan again from Bank of America, out with a note this morning saying it would cost 90% more for your iPhone if that happened. 25% just for the labor to build it here in the United States. Forget about how long it takes to get a factory up and running. And that means all the supplies and materials coming in from overseas, those raw materials that turn your iPhone into an iPhone. It can't just happen magically, and it can't just happen cheaply. So
yeah, and that's assuming that you took all the people who are doing it in China and shipped them over here.
Exactly.
And paid them what you'd have to pay them
exactly.
here.
$70 an hour or something.
It doesn't even count,
it makes no
build
sense.
up in knowledge that you would need.
And so Apple's
but what this does do, though, I imagine, with this 90-day lag, it suggests that the Trump administration is not trying to hurt companies like Apple.
Exactly.
So there's possibly something else, some other level that can be pulled between now and then to keep Apple from getting really
a little bit of hope that Apple either convinces the Trump administration sometime in the next 90 days, let's call it, that let's get an exemption. That's been the idea, by the way, within Apple since Trump was elected, that these tariffs are just going to be surgical. We'll get exemptions. Tim Cook, I'm going to show up to the inauguration and donate $1 million to Trump's inauguration fund, and I will win these exemptions like I did in his first term. That has not happened yet, so there's a little hope that that can happen again today. But again, diverting everything to India is just not going to happen anytime soon. Vietnam is also an important one. That is actually good news here for Vietnam. A lot of AirPods are made there, watches, I believe some Macs. Malaysia, another big, important, growing manufacturing center there. So there is some good news in here, and there is good news. I want to make that very clear, that things are getting better now with this pivot that we're seeing from the White House. But China is still a huge bear right now, and there's a lot more to work through. By the way, we've heard no clarity from Apple on any of this. We don't know what their plan is. We don't know if they plan on increasing prices, if they plan to absorb it. The best we have is just really smart people doing some back-of-the-envelope math to try to figure out what this is going to cost them.
Which is business as usual for Apple. But we know Tim Cook does have the president's number in his iPhone. Steve, thanks. Now let's bring back Mike Santoli for a look at valuations for Apple and tech. Mike?
Yeah, John, with the question of did the sell-off really reset valuations in a way that really improved the risk-reward? Well, maybe so. This is the forward PE of Microsoft, Apple, and the NASDAQ 100 as a whole. You see it came down quite a bit in a short period of time, but I have the 15-year chart here mostly to show that all it did is bring you back to the bottom end of the range in almost every case that really has been in place since COVID, since the pandemic rally and all digital businesses and things like that. So obviously didn't make these stocks absolutely cheap. And the rally, by the way, since we made this chart would have even brought up those PEs by a couple of points in most cases. So I would say certainly not as expensive. Certainly it restored some level of margin of safety, but not exactly super cheap in a bad economic scenario. Take a look here at how the S&P has performed after 80% of all of its stocks have gone below their 5-year average PE. So when they're below the 5-year range, on average, 80% of all stocks, this is from Evercore ISI, the forward returns over the next month, up 7%. Guess what? We got more than that just today because this just happened. Over 3 months, you see 11% average, 18, 31. Now, those are the averages, and this is the band of returns in all instances. So you actually, in some instances, have lost money for 1, 3, and 6 months after that happened. So it's not like a 5-year average PE is some kind of magic threshold to buy once you fall below. I'll point out that this analysis starts in 2015. My expectation is if you brought it back to 2000, you would have seen not such great results just because stocks were down in PE because of where they started.
Speaking of PE, Mike, should we expect revisions on the E side anytime soon?
Yeah, I think that's kind of just going to be an ongoing process as we get through earnings season. Normally the pattern has been, analysts, they kind of trim their expectations over the course of a quarter, then companies almost universally beat by a few percentage points in aggregate. That's going to be an interesting dynamic. It's hard to imagine that's going to be reliable this time, that companies are going to beat by that much. We talked about they're going to have cloudy outlooks. I will say, though, when the PE comes down and when the market is starting to pay less per dollar of earnings, that's the market's way of bracing for lower earnings, right? It's not just some abstract thing. It's also the market's expressing its sentiment on how reliable those earnings look like they'll be.
Okay. Mike, thanks. Well, still ahead, should you trust today's bounce and put new money to work here? We're going to talk to one expert who says you might want to hold off on making any big moves. And we will talk about how the Fed is navigating this whiplash of headlines out of Washington and what it all means for rates when we're joined by former Kansas City Fed President Thomas Hoenig. We'll be right back.
Power E-Trade's award-winning trading app makes trading easier. With its customizable options chain, easy-to-use tools, and paper trading to help sharpen your skills, you can stay on top of the market from wherever you are. E-Trade from Morgan Stanley. Power E-Trade's easy-to-use tools make complex trading less complicated. Custom scans help you find new trading opportunities, while an earnings tool helps you plan your trades and stay on top of the market. E-Trade from Morgan Stanley.
Back pain. When you've got it, you know it. Introducing the X-Back from CopperFit, our groundbreaking technology designed for compression support of your lower back and core like you've never experienced before. Engineered with our most innovative, patent-pending, Advanced X compression system. Evenly distributes the support across a broader surface area of your back for relief of lower back aches and pains. A super lightweight mesh fabric, ventilated to increase airflow and release excess heat. An orthopedic designed alloy support panel and 4 built-in flexible stabilizers to help improve alignment and promote better posture. The all-new X-Back from CopperFit, the most customizable support for relief of lower back pain you will ever wear. Guaranteed or your money back. Get yours now at getxback.com or call 1-800-431-0624. Order right now and your shipping is free. CopperFit. Feel the difference.
Wall Street's terrified by the tariffs, but we have an arbitrary mercurial president who can declare victory, roll these tariffs back with a stroke of a pen, and at some point the White House won't be able to tolerate a crashing stock market.
Mad Money, weeknight 6 Eastern, CNBC.
These bills are crazy.
She has no idea she's sitting on a gold mine.
Well, she doesn't know that if she owns a life insurance policy of $100,000 or more, she can sell all or part of it to Coventry for cash, even a term policy.
Even a term policy?
Even a term policy!
Find out if you're sitting on a gold mine. Call Coventry Direct today at 800-476-0100 or visit coventrydirect.com.
All right, locked in for this meeting. Total focus. Double booked? All good. Otter AI gives meeting notes and insights, even on meetings I can't attend. Dang it, I picked the boring one.
Otter, the AI meeting agent.
Welcome back to Overtime. If you're just joining us, a historic upward push for the markets today after a historic sell-off over the last week. Today's jump, Dow up nearly 3,000 points, comes after President Trump paused tariffs for 90 days on most countries, China being the exception. S&P 500 turning in its best day since 2008. The Dow, as I mentioned, logging its biggest point gain ever, and the NASDAQ having its second best session ever. And we've got some more breaking news now out of Washington. Our Emily Wilkins has those details. Emily.
Hey, John. Well, look, the markets might be feeling good about tariffs. Republicans here in Congress are trying to add more good feelings to the markets by advancing Trump's agenda that includes, of course, that $5 trillion in tax cuts. But right now, that package is looking like it is going to be in trouble. The House just took a procedural vote to move forward, and you saw 3 Republicans come out against it. That is the most that Republicans in the House here can lose. If they lose even one more on this next vote, it's going to mean that this tax cut is going to be very, very difficult to get through, that there are going to be issues. A lot of the lawmakers who I've spoken with have said the real concern here is that they are moving forward a package that, for the Senate side at least, has limited cuts, only $4 billion in federal cuts, while adding $5 trillion in tax cuts to the deficit. And they're very worried about that imbalance, about what that could mean for the bond market. I've talked with a number of lawmakers today who say they're looking for assurances that the Senate really is going to cut spending along with the amount that they want to spend. But we only have a couple more hours here. Speaker Mike Johnson has said he wants to have this vote today. He's worried about attendance issues tomorrow. So we'll be keeping a close eye on this for the next couple hours and see if they can actually advance the tax package and the rest of Trump's agenda. John?
Yeah, those House GOP budget hawks don't like that new math from the Senate. Emily, thanks. Well, it is time for a CNBC News update now with Kate Rooney. Kate.
Hey there, John. An appeals court today cleared the way for the Trump administration to once again fire about 24,000 federal workers at 18 agencies. The probationary workers faced those cuts as part of the administration's purge of the federal workforce. The ruling overturns an earlier judgment that the firings violated regulations for mass layoffs. A federal judge, meanwhile, just ruled that the conservative cable news outlet Newsmax defamed Dominion voting systems with false reporting that accused that company of rigging the 2020 election. Dominion is seeking $1.6 billion in damages, which will be decided in a jury trial, which is scheduled to start on the 28th. And President Trump just signed an executive order against the Sussman Godfrey law firm. It's the latest in a string of orders targeting firms that have represented clients in disputes with the president. Some of those firms are now fighting the actions in court, while others have reached deals with the president on his demands. They're pledging millions in pro bono legal services and agreeing to abide by the president's orders on DEI initiatives. John, back over to you.
Kate, thank you. Now let's get back to today's historic rally, also the highest volume trading day on record. Let's bring in BD8 Capital Partners founder and CIO Barbara Duran and Citi Research Director of U.S. Equity Strategy Drew Pettit. Guys, welcome. Barb, can you buy here?
That's a big question. I think a lot of people are dying to buy. It was a big sigh of relief today. I was on the phone with a client who was really, really nervous about the portfolio. And I was happy to say in the middle of the call, came out the tariff news and her portfolio was up 10%. But is it a buying opportunity? I think there'll be some follow through. I think there's select stocks you could buy, things like maybe Netflix that have held up, but I don't think it's a big rush to buy, even though you could see some follow through here. And the reason is there's still big uncertainty about these tariffs. It's been on again, off again. We're still waiting to see if there's going to be tariffs on semis, on pharma. And plus, this is only a 90-day reprieve. And frankly, this administration, I think, has lost a lot of credibility in the way this has been rolled out. And I think there's been a lot of caution among consumers and management. So I'm not saying the worst, I think, is over. I think a bottom has been put in, unless we go back, to these high, quote, reciprocal tariffs. But I just think there's too much uncertainty. And in fact, this kind of reminds me when China, back in the 21 timeframe, made some decisions against Alibaba, some education companies who lost 50 to 70% of their value, and there began real distrust of government interference. And I think that really disincentivized people to invest in that market. And certainly you saw what happened today with the 10-year. And I think that with it going up to 4.5%, suddenly it was like, oh, yeah, 24% of our treasuries are held by foreigners, with Japan and China the top two holders. And if they stop buying or on the margin, it's a problem. So I don't think the coast is clear yet.
Drew, how has the narrative changed? My sense is that there are a lot of retail investors out of there who are out of position, maybe have more risk than they wish they had, aren't diversified in a way that many of the professionals think would make sense in the market as we see it today. What do you think?
So it's funny, when I think about, honestly, the ETF flow trends and the professionally managed side of retail, we've actually seen record flows into fixed income leading into this month. So I think while the retail investor might be chasing some kind of YOLO stocks and get rich quick types of trades, I do think there's more professional management overlays now where you actually saw a lot of buying of bonds and safety leading into this month. Look, this is a big move today. This is messy. This kind of gets you flip-flopping back and forth between the bears and the bulls, but we're right back at that 5,500 level, which we were talking about balancing risk reward if we had a 10% broad tariff. So from here, look, I'm just going to echo what we just heard. It's, do we hear about more sticks in tariffs coming, or do we start to hear some good news about taxes? And let's just call that the carrot on the other side.
Barb, it's almost like we're speaking as if we weren't talking 125% tariffs on China and 80+%, 85% or so from them coming back. I mean, China's a big trading partner. We in the U.S. buy a lot of cheap stuff and a lot of expensive stuff, thinking about Apple from China as well. How do you factor that in as an investor, even if you're mostly holding tight to your strategy? How do you factor in a trade war between these two superpowers?
Well, it's not just a trade war with them. There's obviously all the other tariffs, like this 10% and the 25% on autos and steel and aluminum, that are still there. And China, if you look at, our GDP is about 11% is from imports, and China is about 14% of that. And as you just said, we get things like toys and furnishings and textiles from them. And so those prices, with those kind of tariffs, are going to go up. And the question is, the consumers that tend to buy these things, they come in as low cost. These are the lower income consumers, and it's going to hurt. But there's a lot to factor in here. We don't know yet the extent of it. It's going to affect earnings. We'll see how inflationary it is. And so there's just still so much we don't know. And earnings season starts Friday, but I think it's still a little soon for the companies to have specifics. They can talk about the problems and what probabilities, but I think we're not going to get a lot of color in those first few weeks of our earnings reports on what the impact could be.
Nobody will blame them for not giving too much color. Barbara Duran, Drew Pettit, thank you. Well, up next, former Kansas City Fed President Thomas Hoenig on whether the Fed should be making any moves with so much volatility around these fast-moving trade headlines. And U.S. Steel sinking right now in overtime on some fresh headlines. We've got all those details right after this break.
Experience the rich maritime heritage of New England with American Cruise Lines. Known for its spectacular shoreline, charming seaside villages, and of course, the world's most delicious seafood, New England offers the perfect summer getaway. Aboard the newest fleet of small ships, Experience award-winning shore excursions while visiting the most beautiful ports in the region, including Newport, Martha's Vineyard, and the Maine coast. In your spacious stateroom, magnificent views await you on your private balcony, while our gracious onboard staff ensures that your voyage will be unforgettable. Begin your journey with the leader in U.S. cruising. Visit AmericanCruiseLines.com or call for a free cruise guide. Small ship cruising, done perfectly.
Did you know that your life insurance policy is an asset that you can sell? Hi, I'm Jay Jackson. I'm the CEO of Abacus Life, and for almost 20 years, we've been purchasing life insurance policies from seniors just like you. In fact, you can use the free policy value calculator at abacuspays.com, and in just seconds, you can learn what your policy might be worth.
The premiums were getting unreasonable, so we sold ours.
And for more than we expected. For many of my clients, selling their life insurance to Abacus was right for them and their estate plan.
Selling your life insurance policy can be a safe, smart choice for many seniors. Don't sell or lapse your policy before going to abacuspays.com or calling 1-800-900-PAYS to learn what the fair market value of your policy might be. There are no fees and no obligations, just information. Get real value from your life insurance when you need it with Abacus.
Let's just get a closer look.
Mom? Nina, wait!
You've got to see this.
Epic Universe, only at Universal Orlando Resort.
I have a structured settlement and I... Call J.G. Wentworth, 877 cash now.
I have an annuity, but I need cash now.
Call J.G. Wentworth, 877 cash now.
It's your money. Use it when you need it.
Call J.G. Wentworth, 877.
Call 877 cash now to get a $100 gift card for a free quote.
Meet Omnilux Contour, an LED light therapy mask clinically proven to reduce fine lines and wrinkles. Find out how you can improve your skin at OmniluxLED.com.
Is Cialis Daily better than Viagra? Does it last longer than Viagra? Are sample packs available? Get started with a 30-day sample pack. Generics now only $1 per tablet at rexmd.com/30.
More breaking news out of Washington. Let's get back to Eamon Javers at the White House. Eamon?
Hey there, John. That's right. President Trump talking to reporters in the Oval Office just now, making some comments on U.S. steel that are moving markets. Here's what he said.
Industry, but now it's going to thrive, maybe like never before. I mean, if you go back to U.S. Steel from 90 years ago, it's incredible. It was the #1 company in the world for a long time. That's why we don't want to see it go to Japan. And we love Japan, but U.S. Steel was a very special company. We don't want it to go to Japan or any other place, so we're working with them.
So it seems to be an indication from the president there that he doesn't back that Nippon Steel, U.S. Steel deal. That obviously, as you can see on your screen right now, John, moving the price of U.S. Steel, though he says U.S. Steel is in a position to thrive now, given everything that he's done to reset trade.
Although the president has been known to change his mind. Eamon Javers, thank you.
Including today, yes.
Yes. Markets roaring back after President Trump authorized, as mentioned, a 90-day pause on reciprocal tariffs. Joining us now on what this means for the Fed's next move is former Kansas City Fed President Thomas Honig. Thomas, thank you for joining me. Any precedent for these extreme policy moves leading to extreme market moves and big reversals?
Well, no, this is unusual. Let's just face it. I think the Fed was anxious, very anxious, if you will, that these tariffs were going to keep rolling as they have been. And I think they're breathing a sigh of relief right now because there was a lot of issues around that had to do with liquidity in the market. People, they were moving away from the U.S. We saw the 10-year and the securities yields on those moving up. There was concern about refinancing the debt. Those are all things that were on the table, and now they have this kind of breathing room and hopefully turn to a little more normal circumstances. But remember, I think we're all paying attention to the tariff, as we should, But also, the United States has a significant amount of debt to both refinance and refinance new debt, and they're right in the middle of legislation around reconciliation and more spending and more issues around tax cuts. These will affect the debt, and the debt is really quite
coming in the next 90 days. What does this do to inflation expectations? What does this do to business confidence and willingness to spend? What does this do to lenders' willingness to lend?
Well, let's just start with the 90-day pause. That's a pause. There's nothing that's reinforcing about this. We're in this thing, so that means uncertainty remains. That means investment has to be much more careful, holding back. So that's number one. Inflation expectations, even where we are right now, as someone said earlier, we still have big tariffs in place on steel and other items. We still have a trade war going on with China. These create inflationary, I think, pressures that we can't ignore, and that's going to be on the Fed's list as well. So their March projections for inflation were modest in terms of very little change. How's that going to affect their thinking going forward? It's going to be higher. It almost has to be X energy at the moment. So I think there's a great deal of.
So does this pause make it? Does this pause make it any easier for the Fed to cut?
Well, I don't think so. No, I think it gives them time to assess. And is it going to be longer term? Does this change their outlook? I think they need to be careful because inflation is still an issue. They're not even close to 2% in my terms. They're still, we're still talking 2.8%, 3%. When you look at the CPI, even higher than that. So they still have an inflationary issue. And I know they're paying more attention to employment, but that's still steady right now. So there's no real cause for them to cut rates at this point. They need to watch.
All right. Thomas Honig, an inside look that you can give us. Appreciate it. Thank you.
You're very welcome, John. Take care.
Up next, a top tech CEO on how he's navigating this economic and market uncertainty as he unveils new products as well. And check out the Nikkei futures up 8% following the rally in the U.S. Overtime will be right back.
You founded your kayak company because you love the ocean, not spreadsheets. You need to hire.
I need Indeed.
Indeed you do. When you sponsor a job on Indeed, candidates can find it easier, so you can hire easier. Visit Indeed.com/hire.
Why should you trade options rather than stocks? Because they offer higher returns, are cost-effective, and can actually reduce risk. Learn how in our new book. Get a free copy today at itsnotanoption.com. Itsnotanoption.com.
It's time to feed the dogs real food in the right amount. A healthy weight can help dogs live a longer, happier life. The Farmer's Dog makes weight management easy with fresh food pre-portioned for your dog's needs. It's an idea whose time has come.
Consumer Cellular, ranked #1 in network coverage and customer satisfaction.
Hi, my friend Linda has you guys and gets way better coverage than I do.
Sounds like Linda has you beat.
Only in coverage.
And plans start at $20.
Okay, price too.
Get your second month free when you switch to Consumer Cellular.
Franklin Templeton ETFs. With over 70 ETFs, we have solutions for every market, helping advisors build the portfolios of the future today. Franklin Templeton, your trusted partner for what's ahead.
I can't do it! Cut this gap! It's just too big! Bring on the double. Aflac! After my hospital stay, Aflac helped close the gap by paying me cash for expenses health insurance didn't cover. Nothing covers gaps better than the Aflac duck.
Get help with expenses health insurance doesn't cover. Find an agent, get a quote at Aflac.com. You do look like me.
Power E-Trade's award-winning trading app makes trading easier. With its customizable options chain, easy-to-use tools, and paper trading to help sharpen your skills, you can stay on top of the market from wherever you are. E-Trade from Morgan Stanley. Power E-Trade's easy-to-use tools make complex trading less complicated. Custom scans help you find new trading opportunities. while an earnings tool helps you plan your trades and stay on top of the market. E-Trade from Morgan Stanley.
Welcome to CNBC's Crypto World.
CNBC's daily digital show has trading updates, the latest headlines, a global perspective, and high-profile interviews. Scan to watch CNBC's Crypto World, sponsored by Crypto.com.
Welcome back to Overtime. Today's tariff pause sending stocks soaring, but for executives, uncertainty and volatility remain. So how are tech CEOs gaming out the next few months? Well, joining me now is Atlassian CEO and co-founder Mike Cannon-Brookes, fresh off the stage at Team 25, the company's annual customer conference. Mike, good to see you. So there's uncertainty out there for business on the macro. What's the impact on their willingness to spend on software that drives communication, drives productivity, including the new AI features that you guys announced today?
Yeah, thanks, John. Look, it's great to be back. There's no doubt there's uncertainty in the macro. You called it correctly. I think good businesses are looking longer term. They always have to be managing the short term. That's part of our jobs. But to look at the long term and working out the customer outcomes that they're going to get. So a lot of our new software in AI and in the system of work for all teams and how they collaborate is going to help them get more efficient as a business. And that's going to be a problem they have this year, next year, and the year after. So we've always been a very long-term thinking company. So we try to focus on that.
What do you have to do in the way your people engage with the customer, in the way you're even deploying agents in the software to take up features for them in an environment where they're not sure how much they're going to have to spend, right, in the coming quarters? How do you get over that delay hump that usually comes as the economy slows down and customers start pushing out the decision on whether to buy?
Look, I think it really sharpens their focus on the value they're getting from their software, right? Atlassian software has always been incredible value for money. And at times like this, it's where they're looking for even more value, not only in the price of the software versus what they get in exchange, but specifically, can it make them more efficient? Can it drive other gains in their business? And can you prove that value to them? We talked today about having removed 200 million meetings from our customers in the last 12 months. That's a lot of time that they're going to get back to spend on other activities. So if you can demonstrate that your software has a high ROI and a return to them in terms of their investment, I think there's always a great space for that.
Mike, stick with me for a moment. We're getting more tariff headlines from President Trump. Eamon Jabbers has those details. Eamon?
Hey, John, the president appears to be putting a lid here on the tariffs on China. The president saying to reporters he's asked, do you think you'll have to increase tariffs on China even more before they come to the table? The president responding, I can't imagine it. So the president there, John, seeming to signal here that he is ready to put a lid on those tariffs, at least for now, and wait and see if he can get the Chinese to the negotiating table. Back over to you.
And to escalation, Eamon, thank you. Mike, coming back to you now. Now, you guys at Atlassian are technically an Australian company. You IPO'd here on the NASDAQ. I was there at the NASDAQ that day. What, from your view, is happening to this push toward globalization that, in a way, a company like Atlassian represents, right? You got customers all over the world. You IPO'd here. You've got employees all over the world as a remote-first company. Do you see that trend being in mortal danger?
Look, I think what we try to focus on is our customers. Our customers are in more than 200 different countries and territories. They will all have unique challenges going on. Maybe at the moment more unique challenges than at other times, but they still have their own customers that they have to deal with. So we have employees all around the world. We have customers all around the world. We are used to navigating global issues. They're going to keep coming up. And what you want is your software, your tools to be agile enough to help you respond. There's no doubt there's management teams out there that are changing their plans at the moment. They may be pausing some. They may be accelerating others. The question is how quickly can they respond, and we like to think that our software helps our customers be more agile to be able to respond to whatever changes may get thrown at them by the world today.
What are you telling your team?
On to whatever changes may get thrown at them by the world today.
What are you telling your team
from the NASDAQ market site in the heart of New York City's Times Square, this is Fast Money. Here's what's on tap tonight. A pause that refreshes stocks with an historic rip higher on the back of President Trump putting reciprocal tariffs with over 75 nations on hold. The Dow climbing over 2,900 points, the NASDAQ surging 12%. Staggering. Another S&P 500 closing up another 9.5% higher today. But can you trust this rebound? We'll debate that. Plus, Trump versus China. While tariffs are on hold for other countries, China's getting hit even harder. President Trump upping the ante again against Beijing. So how will this battle between Trump and Xi play out? Former Morgan Stanley Asia chair Stephen Roach is standing by. And later, we'll go inside the rebound sector by sector, from retail to airlines to pharma, banks, and more. A must-see hour coming up. I'm Melissa Lee, coming to you live from Studio B at the NASDAQ. On the desk tonight, Tim Seymour, Bono and Ison, Guy Adami, and Michael Schumacher of Wells Fargo Securities. Welcome, Michael. We start off with a pause heard round the world. Stocks roaring higher midday after President Trump said he authorized a pause on most tariffs. The S&P, which had seesawed between gains and losses all morning, surging more than 9% on the news, its best day since October 2008. The Dow swinging 3,500 points from low to high, clocking its biggest point gain on record. The Nasdaq surging 12%, its best day since January 2001. Even the small cap Russell 2000 up nearly 9%. And take a look at mega cap tech. Tesla soaring 22%. Apple up a blistering 15%, its biggest gain since 1998. Together, the Magnificent Seven added $1.8 trillion in market cap today alone. But even with today's gains, major markets still down sharply in the week since the tariffs were first announced. And most are still down more than 10% from their records. For the latest on what has been coming out of the White House all day, and it's been a lot, let's bring in Eamon Javers. Eamon.
Hey there, Melissa. You're right. The headlines have been coming fast and furious from this White House. We've been getting some insight into the president's thinking over the past couple of hours as to why he made this decision when he did. He said he was watching the bond market, some anxiety there. He's watching financial markets. He said people were getting a little yippy in markets. And he also said that he was watching Jamie Dimon on television earlier today, who was making the case that, this could be a recession if these tariffs stay on. All of that clearly brewing in the president's mind. And just within the past little while, he's been in the Oval Office taking questions from reporters. He said in there that he views this as the top end for tariffs on China. He said, I can't imagine putting additional tariffs on China. He also said on U.S. Steel that he wants to keep U.S. Steel American. He doesn't want to see that company sold to the Japanese. That moved that stock as well. And then he also talked a little bit about this idea of whether this was a negotiation or not. He was asked by a reporter in the Oval Office why it was that his aides and staff members here at the White House were saying this is not a negotiation, when the president today is saying it is a negotiation. Here's how he answered that question a short time ago.
A lot of times it's not a negotiation until it is, and that happens. And, I said outside that you have to have flexibility to do it right, and that's what we have. We brought everybody to the table. And it may not be a negotiation. It may not last. I mean, things may be asked that I think are not fair to us.
So the president saying there of this 90-day pause, it may not be a negotiation, it may not last. So the devil clearly is going to be in the details here in terms of all of these 75 countries that have approached the White House about the idea of negotiation. And now, Melissa, what you have in terms of market uncertainty is this question of all of these simultaneous negotiations going on while the tariffs are paused. We're going to get a lot of, blips and readouts and movement in all of those negotiations over the next 90 days. And so all of that is presumably going to be influencing financial markets as we go through the next 3 months.
Eamon, thank you. Eamon Javers joining us from the White House. The bottom line here is we still don't know what's going to happen in 90 days. We know that the 10% tariffs are going to still be in place across the board. Are we better off now, Guy, than we were before?
Through the lens of the market, yes. So a couple things. I think the stock market was probably annoying this administration. I think the bond market, specifically last night, scared the administration, or at least it should have. And the fact that President Trump says, he watched the bond market, he listened to Jamie Dimon, and he made a decision based on that, I actually admire it, because things were going a little bit sideways for a period of time. So that's the good news. The bad news, I think, is the move that we saw today rivals moves we've seen historically. So 15 of the greatest moves of this magnitude, 8 of them took place in the 1920s and the early 1930s, some of them during the Great Financial Crisis, and some of them during long-term capital. So I'm not suggesting we're at any of those levels, but these are the types of moves we've seen in times of uncertainty. I'll also say this quickly. On Monday, none of us were breathless here. We said the market traded down to a 4-year trend line. Carterworth pulled the chart up. We said, at least in the short term, that's a good level to trade from. We actually said this S&P could trade up to 5,500 over the next few weeks. I didn't think it would happen over 2 days, but here we are, Mel.
What did you make of the move in the Treasury market over the past couple of days, Michael? But most notably, I mean, we're at 4.35 right now on the 10-year yield. Pre-Liberation Day, you know, the close of 4.1, we were at 4.17, so we're still higher here.
Yeah, it's interesting, Melissa. The 10-year began this year at 4.55, 4.60, kind of in that ballpark. But the move the last couple of days, downright scary. So there's been a lot of selling of cash treasuries really throughout the last week, 8-9 days, something like that. Generally speaking, that was offset by flows in derivative markets, but not in the last couple of days. People were just saying, I'm out. Really, it was a flight from balance sheet. Any sort of transactions, any trades, positions that required a lot of balance sheet. People like to talk about hedge fund basis trades being liquidated, things of that sort. But there was really no bid coming out. And also, you had the 10-year auction today, 30-year bond auction tomorrow. Talk about raising the U.S. Treasury's funding costs. This was it. So I can understand why Trump reacted to that.
Yeah, I agree. It's great to be unliberated. And it does feel as if this is an equity market day. It's an equity market story, but it's really the bond market. And the bond market and even the currency markets are pushing us around. In other words, if we looked at, 1245 even, the bond market was telling us something. And it's definitely, I think something we need to listen to.
All right. Well, the driver for today's massive market turnaround, the president's announcement of the reciprocal tariff pause for 75-plus countries. One of the key players in the middle of today's decision, Commerce Secretary Howard Lutnick. He joins us live from the White House right now. Mr. Secretary, great to have you with us.
What a great day for America, isn't it?
It is a great day. If you take a look, though, at the pre-Liberation Day close on the S&P 500, we're still lower from where we were then. And we did suffer, not only declines in the equity markets, but also, some crazy moves in the fixed income markets. Did the market reaction cause the administration to rethink its tariff plan?
Absolutely not. Absolutely not. The tariff plan for the president, look, he's trying to fix the fundamental trade imbalances that have been going on for this country for 35 years. I mean, we were just in the Oval Office, and he said, I don't blame China. I blame the people who sat behind the desk in the Oval Office for letting this occur. It is time to take back the ability to trade with America, and Donald Trump is leading the charge to do that.
We understand that. That certainly has been the administration's, thesis this whole time, Howard. But at the same time, we had Wall Street, your former compatriots, come out raising the odds for recession, lowering price targets across the board. There wasn't any element of that feedback that entered the thinking, because some would posit that if Mr. Trump and the administration actually listened to Wall Street and took a look at the reaction of the financial markets, the global markets for that matter, they would find solace in what the administration is doing.
Look, President Trump made it clear that he's got to reset trade. He's got allies and foes, both friends and foes. So what happened is we have so many countries who want to do deals with us. It's just not possible to talk to all, over 75 countries coming in who want to redo trade, who are taking a good hard look at their trading, their rules, their non-tariff trade barriers, their tariffs, their subsidies, their currency manipulation. They're finally willing to say, we'll make a better deal with the United States of America. Can we just have the time to do it? And the president listened to them. And of course, China took the exact opposite path. And you see what's happening. So if China's going to take that opposite path, the president's going the other direction. But for all those countries who wanted to work it out with the United States and make sure they create a fair trading model for the United States, President Trump was ready and willing to sit down with them and make a deal with them. And that's the position we're in now.
According to reports, you met with the various bank CEOs over the past couple of days, and they all expressed their reservations about how the policy was playing out and the impact on the markets. I'm curious, because you've worn that hat as well not too long ago, Howard, and would you think that a 90-day pause would cause businesses to then resume spending, resume deals, resume their activity as they had planned to do at the beginning of the year? I mean, is that enough to sort of spur them to get back on track?
I think it is clear. People want to come and build factories and reshore their production in America. That's why the president talks about the huge commitment of building in America. So the companies are going to come back to America. The fact is these countries understand that it was time to rethink the way they trade with America,
but I'm talking about
the way
US
they trade with China.
U.S. businesses
going to
just doing business here, in terms of, for instance, Walmart pulling its guidance. I mean, what will give do you think a 90-day pause is going to give companies enough confidence to actually give guidance, to be secure in how they're planning for their businesses for the year, headcounts, CapEx, et cetera?
I think it's important for companies to understand that the countries that they do their business in matter. If you do business in China or you do business with a country that basically is just a proxy for China, that you're going to have to deal with the fact that President Trump does not think we're being treated correctly. But if you're doing business in other countries, really understand the country you're doing business in, understand their relationship, and push them to make sure their relationship with the United States of America is fair and correct, and that will be good for business. So what you're going to see is the greatest set of announcements of companies going to build in America. And of course they're going to build in America. That's what's happening. And you're going to feel it all across this great nation. People are going to build in America, and the job creation in America is going to be fantastic. You just have to let Donald Trump drive the car, drive the ship, drive the plane, however you want to call it. Donald Trump is in charge. He understands how to do this, and no one could do it better. And that's just what the market told you today. I understood they doubted it. I understood they were uncertain, but that's what you get. Never bet against Donald Trump.
Mr. Lutnick, Mr. Secretary, does the administration feel that every trade deficit by definition means we're getting ripped off or losing? I mean, I would submit that we could be getting ripped off sometimes, but a trade deficit in and of itself doesn't mean we're losing. By the way, I know you know this. We're 5% of the global population. We're 30% of global GDP, so it's really hard to say we're getting totally ripped off.
Well, you have to look at things like Europe, right? Their population is bigger than ours, right? Their GDP is a little smaller. Why would they have a $235 billion trading surplus with us? Why would we have a deficit with Europe? It's not their cost of production. It's not their regulatory framework. They're the same, if not worse, than we are in every way. It's because they're not having fair trade with us, and that needs to be addressed. So what happens is everywhere the leadership of the United States blinked before, some country came and used it as a launch pad to do business in America. I mean, why is Europe doing so much business with China? Because it was basically a tariff arbitrage. Sell to Europe and have European companies then sell to us. So the idea is let's end that. Let's call it for what it is, which is Chinese companies. They do business through China. They do business through Vietnam. They do business through Thailand. Come on, they do business through Malaysia. We've got to really address it the way it is and say we want fair trade. We want to be treated the way we deserve to be treated. And that's what's happening now. So we have 10% tariff around the world today. And we are calling out China because they are going in a different direction. We're going to work with each of these countries, and we're going to come up with a great deal for America, and hopefully a deal that they think is appropriate. And off we're going to go for the golden age of America. It's coming now. You feel it now. Finally, someone is behind the desk in the Oval Office who's going to protect America and the world. And it's coming now. And I tell you what, it feels great.
Mr. Secretary, I guess the question on how we are focusing on country by country, and you talk about bringing jobs back to America, there's some sense, and please clarify this for me, are we trying to reindustrialize America? And are we also looking to have a trade balance? Well, I mean, it seems to me we industrialized America 150 years ago, and that jobs went overseas because it was more efficient to do that. And we're also at record unemployment. So I'm just trying to understand how all this makes sense together.
So we can't be a nation that invents everything but has everything built somewhere else. Eventually, you become subservient to the people who build things for you. If you make nothing, but all you do is think about it, then someone else will be the builder. And if you also allow these giant trade deficits and you let yourself have budget deficits, what ends up happening is the rest of the world also owns you. In 1980, we owned more of the rest of the world than they owned of us. And now the rest of the world owns 18 trillion net more of the United States than we own of them. So 60% of our GDP is now owned by outsiders. It's time for that to be right-sized and fixed. We're going to reshore great industrialization, bring back those jobs here, and we're going to strengthen America so that America plays the right role in the world and is not just the biggest consumer who overspends and eventually is owned by the rest of the world. That is just not going to happen. My grandchildren had a great day today because my grandchildren had a great day when Donald Trump was elected president. That's what's changing. It's America for the long term of America. Someone had to do it. And you're feeling that's what's happening now.
When you talk about reindustrialization, Mr. Secretary, what do you want to be made here? I mean, how do you envision that manufacturing economy, of the future? Are we talking about bringing back textiles, T-shirts, sneakers, home goods, appliances? What?
Everybody always talks about these silly things.
Some would argue that those are lower value goods, and you want those goods to be manufactured abroad so that the United States can manufacture higher value goods.
And who's going to work those jobs?
So let's just go through this. So you have TSMC, right? So semiconductors. If you think about what is a semiconductor, every button you push means it has a chip. It may not have the newest chip that's in an iPhone, but it has an old chip. Your microwave oven, your refrigerator, your alarm clock, everything's got a chip in it. And that chip is all made in Asia, right? Taiwan makes virtually everything. Taiwan is 81 miles from China, and China has said we're going to take it over. Imagine if China went and took over Taiwan, and every single thing that we want to produce that has a plug, that has a button, is now owned by China, and we have nothing. It is outrageous that we've allowed that.
That's a national security argument. There's no national security argument bringing back.
All right. Well, how about pharmaceuticals? You got a problem with pharmaceuticals? You don't have a problem with pharmaceuticals. How about steel and aluminum? You have a problem with steel and aluminum, right? You need all these things. And what's happening is you need to address it in bulk. You need to address the fact that we can't sell a car in Japan or Korea or Europe. It's just so blatantly unfair. At some point, our economy, our farmers need to be able to sell corn. Our ranchers need to be able to sell beef. We've got to have the world stop taking advantage of us to the tune of $1.2 trillion and have our economy unleashed and be unshackled, finally unshackled. Our farmers have no idea what it's like to actually have a full world to sell to. Our ranchers, our seafood, and our fishermen, they have no idea. These will be fundamental changes. That's why Donald Trump says, make America great again. That's why he says, bring back the golden age. It's really allowing the United States of America to sell its goods to the world. Mm-hmm. We're only selling them to ourselves, really. We have a $1.2 trillion trade deficit. That means everybody else sells to us, and we're not allowed to sell to them. Doesn't that seem unfair to you? If you're in business, doesn't that seem unfair when he unleashes America on the rest of the world and gets fair trade with the rest of the world? America's GDP will grow, our jobs will explode, better jobs, higher paying jobs. That's the point. We shouldn't be growing our GDP 2%. We should be growing our GDP 4 and 5 and 6%. And no one's ever thought about it, and no one's ever tried. And that's what we're doing here, and that's what Donald Trump is doing. And we are all of us who work for Donald Trump, we are his spokesman, but he is the driver. And don't get confused. Donald Trump is the driver of the policy. He authorized just the other day to negotiate. He authorized yesterday, and he came out with this policy today. And there was not the policy before then.
He also seems to be a great stock pundit, Mr. Secretary. Earlier this morning, before the pause, he put out a message saying it's a great time to buy, and here we are. Here we are, much higher.
I'd always bet on Donald Trump. Every time I'd always bet on Donald Trump.
He also wrote DJT, which is a ticker for his media company.
No. Every text
that was just his. That was just
every text he sends to me. That's his name.
But that was a great time to buy the market, right? I mean, uncanny.
Well, look. Donald Trump understands that America is the greatest country. All right, we are the greatest country, and we have the capacity for incredible greatness. But someone needs to take the shackles off. Someone needs to let our farmers sell corn to India. I mean, we had Modi come to visit us, 1.4 billion people, and we can't sell a bushel of corn. It just is not right. It's time for fair trade, fair to America. But it's been fair to the rest of the world. It just hasn't been fair to us.
All right. Mr. Secretary, always great to see you. Thank you for your time.
Thank you. Great to see you.
Howard Lutnick. 5633 was the S&P 500 close on 4/1. We are still below that. We're 700 points, in fact.
Didn't the market rally today because we paused this policy?
Paused. There's still
I'm trying to understand the cause and effect here. I mean, if this is a great day because markets rallied because, in fact, we paused what was seemed to be an issue.
Terrible.
I'm just trying to,
if you're going to call it what it is, then call it what it is on the way down.
Let's call it what it is. And again, it was a day where the market felt like it was great to not, be freed. That's the dynamic. I'll say something else about today's markets move. It doesn't really instill a lot of confidence in markets. And if you think about how there's a lot of retail investors out there that really, this has been, and I would just caution that if you think about the 12% move in the NASDAQ today, the last move, and this pretty much matches the day that we had, I think it was December 3rd in 2008. And then the next 2 days, you were down 4.8% and then down 6.6%. Now, history is very different. There are very different conditions. But I think, what markets have done, and we've talked about this, Michael's referencing the volatility in the bond market. This is the kind of stuff that doesn't really instill confidence.
I tend to agree. If you look at the path of how we got here, ultimately, we all lay out these, whether it's support levels, Fibonacci retracements, 20% bear market thresholds. You don't really get to decide how you get to that entry point. So kind of having somewhat of a systematized way of entering the market does make a lot of sense here. I think Tim really hits the nail on the point. We talk about confidence, and we have seen a pullback in the VIX. You call it confidence, you want to call it fear, you want to call it volatility. They're all essentially, pointing to the same situation. And ultimately, we still lack clarity on what these trade agreements are going to end up being. Is it going to be a country-by-country bilateral situation, or is there going to be a more holistic approach as we look at capital flows, as we look at foreign investment here? And I would like to see more clarity on there before I declare victory. With that said, I will call out both sides. I do think it does take a little bit of humility to say, hey, perhaps we got out in front of our skis, we're going to pause, and we're going to reassess. And
I don't think anybody said that.
Nobody said. In fact, he said it was not anything to do with that. It would have all been.
This was a victory lap.
I'm trying my best.
This was a victory lap.
I'm trying my best here.
All right, let's get to the 10-year Treasury yield retreating from session highs of over 4.5%, a better than expected auction, as Michael had mentioned, and the tariff pause factoring into the move. CNBC's Rick Santelli, what do you make of all the action today? Wow, Rick.
Well, first of all, let's go through 4 charts real quick, and then I'm going to ask the panel a question. First one, he mentioned that strong 10-year auction. It certainly was. So from 1 o'clock Eastern to 1:26, we moved from 446 to 433. We dropped 13 basis points, and that was the catalyst for much more going on. The rest of the charts occurred from about 1:17 to 2:11 Eastern time. The 2-10 spread moved from 67 down to 39, dropped 28 basis points. 2-year note yields surged 35 basis points from 368 up to 403. And these Fed funds, from 118 to 211, they dropped 44 basis points and ended up settling down 27 basis points. And I love this panel. And everybody on the panel asked the one important question to Howard Lutnick. Are we better off after all this? Now I'm going to ask you, and I know the answer. Nobody at that table says yes. You know what I say? I ask you a different question. Who on the panel thinks globalism is stronger today than it was a week ago? Anybody?
Silence.
Anybody think globalism is in stronger hands today?
Nope.
No, of course not.
Because to me, that's the benefit. That's the benefit. You want to know the benefit? Globalism coming to an end. It wasn't fair to America in many ways. Trade deficits, listen, I don't know how any of this stuff's going to turn out, and it's super messy. But in the end, There's no resets in a crisis. Everybody's bringing up past crisis. Next couple of days, historically, are down. You don't get resets in the Tide bot. You don't get resets in COVID. You don't get resets after a tech wreck. You don't get resets after the credit crisis in 08. You got to reset today. This is different.
How did we lose in globalism? I mean, can you explain that? Do we have enough time?
How did we lose in
Maybe
globalism? I don't want other countries to tell the U.S. what to do. Okay? I don't want one world, one government. And without that trust, without everybody kind of conforming to the same tune, without trust, you can't have free global trade. China doesn't trust us. We don't trust China. I mean, it's not really that hard to understand. Globalism had to come to an end. Otherwise, our nationalism has to disappear. And I, for one, I don't care if they call that populism. I call it patriotism. And there's many people that feel like I do.
Rick, thank you. Always great to see you. Rick Santelli.
Thank you.
Michael, on the call today, this afternoon, you said you were talking about scar tissue.
Yeah.
And that was before the pause. But I would submit that the scar tissue is maybe even worse now because you really never know what's going to happen.
It's still there. And we've been talking about confidence in markets, but think about confidence at the CEO, CFO level. You get a 30-day pause, a 90-day pause in this case, big deal. Are you really going to build that new plant or think about that new business line? I don't think so. I've talked to a ton of clients on that side of the table in the last couple of weeks, and they're just dazed and confused like most of us are. So how can they really do planning at this point? They don't know what the rules are. So I do think scar tissue is a good term. I think it's in play for markets. It's in play also for business types. It's a fact of life right now until the administration really says, this is it, we're done, and sticks to it for quite a while.
Yeah, I mean, that was sort of what I was trying to get at with Howard when he was CEO of Cantor Fitzgerald. I'm sure if he were in that room as a bank CEO, his perspective would be a lot different in terms of the freeze in business that you see across the board, the freeze in deals that you see across the board now with all this uncertainty. And is this enough? It's not. I mean, this is 1 quarter of reprieve.
Yeah, China, listen, yes, I don't think it is enough. I think a lot of people realize that it's enough, but in terms of the market, it was enough. And again,
for now,
technically the market, I think, is doing everything we've been talking about for the last few weeks. With that said, I mean, the question now becomes, what's the right multiple to put on S&P earnings in the environment that we're going into? And what are S&P earnings going to be? Because we're not going to be at the 270 level that everybody had sort of factored in earlier this year.
If you think of it, we got Fed minutes today, too, and those Fed minutes were from a meeting that was really before we got liberated. And those Fed minutes made it very clear that there was both concern about rising prices and slowing growth. And we went into this with rising prices and slowing growth. So, the dynamic, and the nice thing about today is maybe it does make this earnings season a little bit more in focus. And we've heard from Delta, we've heard from Walmart, we've heard from real companies that are really touching both the economy and touching some of the other countries in the world and some of their bilateral partners. So interesting.
Speaking of Walmart, shares surging almost 10% today. The retail giant affirming its full-year outlook at its investor meeting today. Courtney Reagan was there, has all the details from Dallas. Court.
Hi, Melissa. Yeah, so the message at Walmart's investor meeting here today is really that it's staying the course. This is in spite of the ever-changing tariff announcements out of the White House. So the retailer leaving its full-year guidance unchanged, reiterating guidance for 3 to 4% sales growth in this current quarter, while also noting operating income range has now widened for this current quarter. Now, CEO Doug McMillon said, quote, "We just don't know enough to say that we're not going to make this year. And our attitude is we're not giving up on that, and we can manage these things." McMillon and other executives noting several times during their presentations that in difficult economic times, more customers come to Walmart and it gains share. It can be looked at as a winner. McMillon said the goal is to keep prices low, especially at those opening price points. But he also noted there's a wide portfolio of products it can flex potentially up and down prices if needed. Now, 2/3 of what Walmart sells in the United States is made or grown here because the majority of its sales are grocery. Now, the countries that it imports most from are China and Mexico, and then it said many, many others after that, but didn't detail percentages. Now, McMillon told reporters he's not aware of any orders that have been canceled as a result of the April 2nd tariff announcement, and he couched that by saying, at least where I sit right now at this moment. Now, if tariffs weren't the main headline today, it would probably be that for the first time in this current quarter, Walmart's U.S. e-commerce business has turned profitable. It's currently about 18% of total U.S. sales, but the long-term projection given today is that it could make up for about half of sales. Melissa?
All right, Courtney, thank you. Courtney Reagan. Walmart said that in order to defend price, they're going to invest in price, which means they're going to absorb some of those price increases. Margins will be under pressure.
They will be, but, I think, listen, last quarter, I thought Walmart, the quarter was fine. We talked about into the quarter, valuation didn't make sense, and to take money off the table. That was right. I didn't think we'd get as low as we did, but here we are. At current price, we're trading at 30 times next year's numbers-ish, which I think for Walmart is actually somewhat reasonable. So, yeah, they'll sacrifice a little on margins. I think they'll make it back on AI, and I think Walmart wins in this environment.
Well, Walmart always wins in dictating price. So they're going to stay there. They should stay there. They're dominant, and they're going to be even more dominant. They said that e-commerce is going to be 60% of sales within 5 years, and it's only 20% now. So, I think you're staying long Walmart. Whether it needs to come down in multiple is a very another story, but Walmart is best in class.
Yeah, too expensive, Bonawyn?
I don't think so, particularly given the volatility in the market. I think you take some comfort in knowing that, they have that large grocery item, and then the tariff uncertainty, as I said, 67% of their goods are homegrown. So I think you have some buffer there.
Coming up, upping the ante in the China trade war. While Trump paused tariffs on most countries, Beijing was hit with more. What one policy expert sees next in the tariff tit for tat. You're watching Fast Money live from the NASDAQ market site in Times Square. Back right after this.
Don't you hate that dirty old hose? It kinks, splits, and it always leaks. And it's way too heavy to carry around. It's time to get the brand new Pocket Hose Copperhead. Just turn on the water and watch it grow to a full-size hose. It stretches and expands like a rubber band. Old-fashioned hoses get kinks and creases at the spigot, but the new Pocket Pivot swivels 360 degrees. Just connect to the spigot and watch it pivot. And when you turn off the water, away it goes, shrinking back to a pocket-size hose. And it makes it easy to carry and put away. Copperhead. It's the hose that grows and pivots, flexes, and sprays. It puts itself away for another day. The Pocket Hose is so unique and so innovative, it was awarded over 100 patents. Call or go online now to get the super light 25-foot Pocket Hose Copperhead today for only $39.99. But wait, order right now and you'll receive an instant $10 discount. So it's only $29.99. And it gets better. Order right now and get our copper spray nozzle with our exclusive thumb drive free. Simply use your thumb to turn it on or off. And with 10 unique patterns, you'll have a setting for every job. A $30 value. Yours free with every 50-foot Copperhead. Plus, Copperhead comes with a full 10-year warranty. It's that durable. That means you can order right now with total confidence. But this special offer is not available in stores or on Amazon. So order right here, right now. And with rising costs, this may be your last chance at this low price. There is a strict limit of 3 per order. So don't wait. Order now.
To order, call 1-800-713-6881 or visit getcopperhead.com. So call 1-800-713-6881 or visit getcopperhead.com. Order now.
My UTIs were a recurring nightmare.
For the both of us.
Then we found support with Eucora. Eucora has UTI relief products and science-backed supplements that offer a proactive approach to urinary health. I finally feel free. Try today at eucora.com.
New projects means new project managers. You need to hire.
I need Indeed.
Indeed you do. When you sponsor a job on Indeed, it's easier for talented candidates to find it, which makes it easier for you to hire them. Visit Indeed.com/hire.
A Squawk Box exclusive. Amazon CEO Andy Jassy. The state of the consumer, AI strategy, and Amazon's response to Trump's tariff policy. Stay ahead of the market. Squawk Box, tomorrow 6 a.m. Eastern, CNBC.
Welcome back to Fast Money. China, the one country singled out in today's tariff pause. President Trump hiking taxes on Chinese goods to 125% after Beijing retaliated overnight. CNBC's Megan Castella's got more on this. Megan.
Hey, Melissa, that's absolutely right. The president raising tariffs on China while lowering them on the rest of the world, leaving this a trade war pretty much being fought on just one front rather than 85 or more. Administration officials said that the reason for further escalation against only China was because of their steep retaliation. They pushed back when everyone else offered to cut their tariffs. So just to recap the timeline and the total tariff values here, the U.S. imposed an 84% tariff on Chinese goods at midnight last night. Beijing responded by upping their retaliatory tariff to match at 84%. That kicks in tonight at midnight. And then Trump upped his China tariff even further to 125% total. And again, that's on top of any duties that were already in place before he took office this term. Now, the president was asked today about where he sees things going next with China. Take a listen.
China wants to make a deal. They just don't know how quite to go about it. You know, it's one of those things they don't know how quite. They're proud people. And President Xi's a proud man. I know him very well. And they don't know quite how to go about it, but they'll figure it out. They're in the process of figuring it out, but they want to make a deal.
Now, yesterday, Trump did say that he was waiting still for China's call. So even though he called President Xi a friend today, it is still not clear just how much the two leaders might be talking. Melissa?
And Megan, in just the past hour or so, President Trump also mentioned something about TikTok. A deal is still on the table, and it depends on what, everything depends on what China does with that also. That seems interesting.
Absolutely. Acknowledging that deal fell apart as part of this, that it's more than just the tariff retaliation. He did also mention in the last hour, I should say, too, that he did say he can't imagine having to go higher with tariffs on China, that this 125% that he's added this term might be the ceiling, at least for now. But with TikTok and with so many other things, there are ripple effects that can go well beyond the tariff rates.
All right, Megan, thank you. Megan Casella. For more on how China could respond, former Morgan Stanley Asia Chair Stephen Roach joins us now. He is currently a senior fellow at Yale Law School's Paul Tsai China Center. Stephen, great to have you with us. How do you see this playing out?
Well, the markets were clearly in a death spiral, and Trump flinched today and, gave us all some breathing room. But as you heard from Secretary Lutnick, Trump is still clinging to this harebrained scheme to remake the world with tariffs, and that's not something that's going to end well. The China thing is unrelenting. It's important to sort of note the sequence of events. We moved first with these reciprocal tariffs, and then the China responded, and Besant and the president have turned it around, saying China shouldn't have responded. Well, they viewed this as an attack, so they felt they had to move.
This seems to underscore, though, pausing the reciprocal tariffs on everybody but China, and in fact raising them specifically on China, underscores the fact that this is a trade war that focuses on China, and it sort of isolates China as well. And I'm wondering how you think that gets played out in China, and what their next steps would be. I mean, it could be tit for tat and tariffs. So we've always said here that there are many other ways China could retaliate, particularly against countries who do business over there, like an Apple or Starbucks or any other company that has executives over there who could easily be detained for a myriad of reasons.
Well, let's keep in mind, Melissa, that China still remains today our third largest export market behind Canada and Mexico, and the second largest foreign owner of treasuries. So they've got plenty of options to deal with should the U.S. continue to tighten the screws. And, I was in China for 10 days a couple of weeks ago, and it was pretty clear to me, and talking to a lot of senior officials and academics and business people, that they viewed the likelihood of further tariffs as clear justification to retaliate, and they did. And they retaliated after we hit them with reciprocal tariffs, and then after Trump didn't like that and he hit them with a penalty, they retaliated again, and he doesn't like that. So he's throwing a tantrum and continues to want to isolate and squeeze China, and that won't end well.
Hi, Stephen. Mike Schumacher. So 2 questions for you. Number one is, how likely do you think it is that China actually would sell treasuries in bulk? There's been a lot of speculation about market action over the last week. And then secondly, what about the currency, the RMB? So our view at Wells is it weakens quite a bit. So we think U.S. dollar CNH, for instance, goes to 770 in a couple months. Do you think that's possible? how would the government react?
Well, I think the currency option would be preferred over the nuclear option of unloading treasuries. But, if China feels that it is being attacked economically or militarily, they will respond and they will use all the weapons at their disposal, including their vast holdings of treasury, to strike back and defend themselves. So, it's a two-way street, Mike. It's where both nations are dependent upon each other, and we have tools that we've used, and they have plenty of tools that they can use. And right now, it feels like a race to the bottom between the two largest economies in the world.
Stephen, we got to leave it there. Appreciate your time as always and your analysis.
Thank you, Melissa.
Stephen Roach. All right, emerging market specialist. What do you make of the latest move?
Well, I think it's deserved. So again, and we live in a world now apparently where, being a communist is better than being a globalist. But I think China's been an abuser for a long time. And I think our focus on China is really important. And I think China is in a very weak state. I think China is certainly an important trading partner, but I think we're a lot more important. So, whether we're doing this the right way or not, I'm not sure I have a big issue with how we're doing it. I think as it relates to China, my guess is they tend to play the longer game, and I think that's a problem if we try to play the longer game with them. Over the longer period, I think actually they've extracted a lot of value. So I say we push hard. I'm not surprised that we kept the pressure on China, and I think we will.
At what point do you think you get concerned or markets get concerned that China will use the nuclear option, as Stephen called it, in terms of selling treasuries or stepping back from? I guess in recent months they've already step back, but in terms of participating in auctions, et cetera? Yeah,
they've been stepping back for a couple of years, Melissa. As far as actually selling en masse, I think Xi Jinping would have to get up one morning and say, you know what, I'm willing to take a 25 to 50 billion hit. It's that kind of thing, and mark to market. Does he want to do that? Probably not. Would he? Maybe, conceivably. But I think there are better ways to go. I agree with Stephen Roach. The currency option is a better one to play right now.
Coming up, farmers' production pipeline. Will today's news spare drug makers the worst pain, or will continued uncertainty plague the industry? BMO's Evan Siegerman will join us next to lay it out. That is next. Back in 2.
QX80, you are cleared for takeoff. Why go commercial when you can have all the comforts of private? The all-new Infiniti QX80.
Check-in time is 3.
It's 2:55.
I know.
Is this what he's doing now?
As your host, I have some rules. First, no showers longer than 5 minutes. This isn't a spa. No games, no fun.
Yes, Coach.
Meanwhile, at a Verbo, when other vacation rentals make you share your turf with a host, try one you have all to yourself.
What does it mean to be rich? Maybe it's not just about the places you can go, but also the people who welcome you home. It's not about living like a star, but about feeling like one. Rich measures life in laugh lines, in moments shared, and in days well spent. The key to being rich is knowing what counts.
In the off-season, I'm a male hand mop. Now I have Relaxed Fit hands-free Skechers slip-ins. There's no bending down and no touching. I kind of love not using my hands.
Come on, Andy.
I'm out the game. Try Relaxed Fit Skechers slip-ins.
My parents came from Poland. I called my father to tell him I had just made a partner of Goldman. And he started crying on the phone. You establish your goals and you work hard to reach those goals. That's ambition.
I'm Dr. Shannon Klingman, the inventor of whole body deodorant like Mando. It's clinically proven to block odor all day and controls odor for 72 hours. Mando's unique formula stops odor before it starts. That's my secret to better odor control everywhere.
You've got a glow about you, inside and out. Show it to the world with just 10 minutes of self-care. Meet Omnilux Contour, an LED light therapy mask clinically proven to reduce fine lines and wrinkles. Find out how you can improve your skin at OmniluxLED.com.
Okay, $1 million deal on the line. You got this. Recaps and sales meeting insights from all my team's calls? Otter AI, it's you who is man's best friend.
Otter, the AI meeting agent.
Welcome back to Fast Money. Coming up in June, we're doing another live event here at the NASDAQ for Fast Money. And in these whipsawing markets, it does seem like a good time to join us to talk about what to do with your investments and go one-on-one with our traders. For more information, head on over to cnbcevents.com/fastmoney or click on the QR code and you can buy tickets.
I mean, an important time for community, Mel. I mean, what better time to, we'll gather around, we'll have some drinks, we'll answer questions, have some fun. Now more than ever, we need this. So check out the QR code, and we'd love to see you in June. All right.
Meantime, another check in the markets today. Stocks ripping higher after President Trump announced a pause and some reciprocal tariffs. The Dow climbing nearly 3,000 points, its best percent gain since the pandemic. The S&P with a nearly 10% pop, its biggest jump since the financial crisis. And the Nasdaq leading the charge, notching its second best day ever. Every sector in the S&P 500 in the green today. Tech, the best performer, with discretionary, communications, industrials, and materials, all with major gains. Crypto also surging on the rally. Bitcoin back above $80,000. Ethereum, Solana, Ripple also higher. Meantime, biopharma stocks rebounding along with the broader market. The iShares Biotech ETF and S&P Pharma ETF each putting in their best days since 2020. But the industry is still looking for clarity on the impact of tariffs on global supply chains after the president threatened major levies on pharma while speaking at an event just yesterday. For more, BMO Managing Director Evan David Siegerman joins us now. Evan, great to have you with us.
Thank you for having me.
All of you. We're glad to have all of you. In terms of the uncertainty, we were talking about the uncertainty in the markets and how this lasts for 90 days. And we still haven't heard about what these pharma tariffs could be. So how are you advising investors? Are you still assuming that there will be tariffs coming, or are you assuming that there will be some sort of pause in the meantime?
So a few things that we're thinking about. First of all, we love the 90-day reprieve. We're very against any pharmaceutical tariffs. We think they're bad for the sector. What's really interesting is many of our major biopharma companies, so think Merck, Lilly, have a lot of supply, or they manufacture their supply in the United States like Lilly. So they're able to weather the storm. And these are tariffs under emergency powers. So they only last the administration or if an act of Congress comes in and stops it. So a lot of these companies can't really change their supply chain so quickly. So they're going to weather it out. So I advise not doing anything, especially until we have more clarity.
In terms of a lot of the pharma companies that had made investments in Ireland, and Lilly also just reaffirmed its commitment to Ireland, are there many finished products that come from Ireland into the United States, or APIs, active ingredients that come from Ireland into the United States for finishing?
So the Ireland question is very important. So a lot of these companies domicile their IP in Ireland to save on taxes, but they also have to finish and manufacture the products and import them to the United States. So for a company like Merck or Regeneron, they do that and they import their products into the United States to pay lower taxes with the whole transfer pricing thing. A company like Lilly has invested or is committing to invest $50 billion on U.S. manufacturing. So they're committed to manufacturing for the U.S. market in the United States. So they may not have to deal with that. In terms of reshoring IP, especially for a product that's on the market, that's very expensive because Ireland may charge a capital gains tax on the value of that IP. And of course, bringing the manufacturing onshore could take 2 years.
For generic makers, I would think this is a particularly tough situation to be in since the margins are already so thin, and a tariff could make producing generics unprofitable. Which companies do you think are most at risk in that realm? And what can everyday Americans think? How should you think about, even if you're taking a generic, how much those, granted, costs are low in general for generics, but for some people, doubling that price could be a lot.
So most of the companies that I cover really do not have huge generic businesses. They've divested them. So Pfizer, for example, divested them. But when you look at the generics business, generally, a lot of those products are made in India and in China. China, especially, I know that's been a hot topic of conversation today. I think that's something we're closely watching because a lot of the API and finished product is made there. They do a lot of chemical synthesis, bringing antibiotics, statins, other pain medications, all the generic drugs that most people are used to getting for the pharmacy for a couple of bucks. So I'm focused on that because you don't want to interrupt that supply. I appreciate the need to bring some of that onshore. However, doing that would be very challenging. And so I don't know if that's where we really want to focus our energy, given that we have a lot of innovative manufacturing here in the United States.
Evan, in the spring of 2015, Gilead made an all-time high, I think it was $120 a share. Then it became the victim of its own success and had 7 years of just horrible performance. Well, we're back there now, and despite the stock market pull-off, it's hanging around. Is Gilead still a buy here?
I would say so. We're really enthusiastic about the long-acting PrEP launch. They have this drug called lenacapavir launching in the second half of this year. I'd also focus on their durable HIV business, right? They are the king of reinventing themselves from some of their earlier HIV medications to Biktarvy to now longer-acting treatments, allowing them to continue to be profitable and grow through an LOE cycle. I'm also focused on their cell therapy business, which would be totally exempt from any sort of tariffs because those are super personalized medications.
Evan, great to see you. Thank you.
Thank you for having me.
Evan Siegerman. Coming up, banks surging in today's tariff turnaround, and the group is gearing up to kick off earnings season in less than 2 days' time. How our traders are handling the moves ahead of those reports. More Fast Money in 2.
We're sitting ducks, waiting for them to infiltrate our defenses. Millions of tries, and they're in. Uh-oh, this one's in the code.
The game has changed, and public companies are now using convertible bonds to stack Bitcoin on their balance sheets. Once reserved for Wall Street's elite, these are now available to all via ETFs. Introducing BMAX, a first-of-its-kind ETF that invests in convertible bonds of Bitcoin-related companies. Learn more about the Rex Bitcoin Corporate Treasury Convertible Bond ETF BMAX at rexshares.com. Not suitable for all investors. Investors should carefully review the fund's prospectus for objectives, risk, charges, and expenses. Visit rexshares.com to obtain it and read carefully before investing. Distributed by Foresight Fund Services.
You've got a subscription for streaming movies and music, maybe even one for food. But what about when it's your water line that's streaming? Repairs are expensive. Good contractors hard to find. A plan from HomeServe is like a subscription for peace of mind. For one small monthly fee, when a covered system breaks, we'll send a qualified contractor and pay for the repair. Why worry? Get HomeServe and chill.
Plans from HomeServe start at just $4.99 a month.
Call 1-833-812-2141 or visit homeserve.com.
Wall Street's terrified by the tariffs, but we have an arbitrary mercurial president who can declare victory, roll these tariffs back with a stroke of a pen, and at some point the White House won't be able to tolerate a crashing stock market.
Mad Money, next, CNBC.
I'm a supermodel. I used their Baked and Brighten like foundation powder, but I used it over the spackle primer. It was sick. Their squeezy blush, and then their In the Buff lip. I'm a model.
It's lunchtime, and Gary is double booked. Good thing Gary's company uses Otter's AI meeting assistant to take notes and generate a summary. So Gary doesn't miss a meeting and can regain his lunch break. Try now for free. Visit otter.ai or download the app.
These bills are crazy.
She has no idea she's sitting on a gold mine.
Well, she doesn't know that if she owns a life insurance policy of $100,000 or more, she can sell all or part of it to Coventry for cash, even a term policy.
Even a term policy?
Even a term policy!
Find out if you're sitting on a gold mine. Call Coventry Direct today at 800-476-0100 or visit coventrydirect.com.
Welcome back to Fast Money. Bank stocks bouncing off their lows after President Trump's pause on some tariffs, with the group finishing firmly in the green. Goldman Sachs and Morgan Stanley each surging more than 11%, while Citigroup, JP Morgan, and Wells Fargo all seeing gains between 7 and 9%. All this ahead of earnings, with JP Morgan, Wells Fargo, Morgan Stanley headlining the first batch of results out on Friday. Bonawyn, how are you looking at the financials at this point?
Well, I'm looking at credit. Tim's mentioned it. You're starting to see high yield kind of widen out a little bit. In terms of how I would trade it, in terms of me having some type of fear uncertainty entering this, I'd probably stick to JP Morgan. I think they're a well-rounded business. They tend to take a cautious approach. If I'm looking for a little bit more beta, I'd probably play more of the traditional equity trading houses, Morgan Stanley or Goldman Sachs, and look for some trading fee accumulation around this volatility.
What do you think, Michael?
I think broadly, Melissa, my issue is that we think the yield curve's going to flatten. Not a great thing for banks. I'll leave the specific calls to Mike Mayo, the rock star, but in terms of general environment, not that great.
I agree on the credit front. I mean, look at the move. This does not move this way, but Pulp and HYG chart interday rallied 2 points, which is something we do not see. So the market, at least today, thinks credit is fixed. I'm not one of those people, Mel.
If you look at high-yield OAS, and again, you can bring up this spread by looking it up even online, you've gone from 260 to 460 in terms of a high-yield spread in the last 3 months. And Michael, it's interesting you think the yield curve will flatten. Does that mean ultimately you think a recessionary rally in bonds happens? Because that has to be the assumption there, which means you're not that worried about the rest of the world stepping away from our bond market.
Yeah, it's two things, Tim. One is weak growth. So weak growth kicks in, yields drop a bit on the back end. And secondly, the Fed's boxed. The Fed does not want to cut. It's made that clear. If you get an amazing improvement in inflation, maybe you would think about it. I think that's really unlikely for the next few months. So front end sort of sits, long end comes down. There you have it, flatter curve.
We're pretty much out of time, but I mean, we're pretty much baking in a June cut. That'll be really some reckoning with the markets come June when they don't get, if that is true, right, when they don't get that cut that's already been baked in.
Yeah, 100%. And again, the Fed said in those minutes today that we read that were from a little while back, they were already worried about rising inflation before Liberation Day.
Up next, final trades.
There are some things that work better together. Like your workplace benefits and retirement savings.
Presentation looks great.
Thanks. Voya provides tools that help you make the right investment and benefit choices so you can reach today's financial goals. That one. And look forward to a more confident future.
That is one dynamic duo. Voya. Well planned, well invested, well protected.
Experience the rich maritime heritage of New England with American Cruise Lines. Known for its spectacular shoreline, charming seaside villages, and of course, the world's most delicious seafood, New England offers the perfect summer getaway. Aboard the newest fleet of small ships, experience award-winning shore excursions while visiting the most beautiful ports in the region, including Newport, Martha's Vineyard, and the Maine coast. In your spacious stateroom, magnificent views await you on your private balcony, while our gracious onboard staff ensures that your voyage will be unforgettable. Begin your journey with the leader in U.S. cruising. Visit AmericanCruiseLines.com or call for a free cruise guide. Small ship cruising, done perfectly.
That's Michelle Lee West. She's a force on the golf course, and I help her make every shot that she takes the best one possible. I guess I'm a lot like Mizuho. In the same way they help their clients succeed. And like me, Mizuho provides tailored solutions to make a real impact. Everything from investment banking to equities and fixed income, derivatives, and so much more. It's a partnership as beautiful as that birdie. Mizuho Americas, a name worth knowing.
Explain 17 years of outperformance in 30 seconds? It can't be done.
We can tell you that we founded Origin Investments because investors like us deserved a better option.
We're proud to be the largest investors at Origin.
Yet we've never made an investment decision in 30 seconds. We don't expect you to either.
So when you have more time, learn how Origin can help you generate passive income and grow your wealth.
We were built for Ulrich, to lift him up, because when twisted legs and hurtful stares kept him from reaching his potential, we became his support. Every engine and motor, each hand and mind, focused on fixing his legs and lifting his heart, because we were built for Ulrich.
Wall Street's terrified by the tariffs, but we have an arbitrary mercurial president who can declare victory, roll these tariffs back with a stroke of a pen, and at some point the White House won't be able to tolerate a crashing stock market.
Mad Money, next, CNBC.
Time for the final trade. Michael Schumacher.
One theme, two trades, Melissa. Long U.S. dollar. Trade number one, long dollar Mexican peso. We think it goes to 22. Why? Mexico's economy is going to take a hit. Got a reprieve, not big enough. Number two, long U.S. dollar versus China's currency, CNH. Same idea. Think it goes to 770 in a couple months.
Tim.
Great having you, Michael. Citibank, I think, rallies more than the rest.
Bonawyn.
VNM, the Vietnam ETF, I think presents an interesting trading opportunity here.
Guy.
S&P's been like a bad soccer game. Up and down the field, nothing happens. But results matter. AEM, Melissa.
Oh. All right. Thanks for watching Fast Mad Money. Jim Cramer starts right now.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I hope you my friends. Now, I'm just trying to make you all the money. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CBC. Tweet me, Jim Cramer. Treacherous time. Treacherously negative. Treacherously positive. Unimaginably bullish. And just totally nuts. That's all I can say about a day where President Trump put a 90-day pause on most of this harsh worldwide tariffs, exception of Canada, Mexico, and China. And whiz bang. What a move. Incredible. Trump's now going to negotiate with 75 countries that he says are pleading for help, putting a 10% tariff on them now, coupled with a 90-day pause for interim negotiations. But he's still trying to put the screws to China by raising their tariff once again. Now it's 125%, which seems almost comical, unless you have to pay it. Might as well just call it an embargo at this point. The reaction? One of the greatest short squeezes in history. Bye. This is for the shorts.
The House of Pain.
With the Dow soaring 2,962 points. I'm not kidding. 2,962. S&P surging 9.52%. You know, that's the best day since 2008. NASDAQ shooting into orbit up 12.16%. Second best day on record. What the heck is going on here? Is this the art of the deal at work? With the president now sitting down with trembling, compliant trade partners to get meaningful trade reform? Is it a policy of encirclement against the Chinese? Or is he just backing off because the original plan was wrecking the market? Look, don't try to outthink it. That's what I heard all day. That's not what we do. And the president doesn't work like that. He's not going to tell you. What we need to do is learn from this experience, because it might be the Rosetta Stone to understanding the ways of President Trump in his second term. Lesson one, nobody ever made a dime by panicking. They know nothing. I know, I covered that Monday, but I'm pretty sure it was quickly forgotten. Think about it. Think about how many people threw in the towel, said goodbye, said they couldn't take it. They listened to those three fabled words: get out now. Right now, they regret their rash, emotional decision to get out now. But because the market has soared without them, they may never come back. That's what happens. That's how so many people left the market. Yet what happens is they get out, and then it rallies big like today, and that's the end. Bye-bye. Learn to take the pain. Staying the course is how you make the biggest money. Second lesson. If you're negative and you stay negative, why don't you do this? Why don't you send me an invitation to your funeral? Last night, anyone who owned stocks left dejected, despondent, thinking they'd lost fortunes. They needed Xanax. They needed Klonopin. But those who went home short, and boy, oh boy, did a lot of hedge funds go home short. I don't know. They were high-fiving and cheering like, ha! You know, like, ha! And they were under the assumption that they made their whole year in a week. I know some of these people. They were like at Harry's, just slamming them. Those who put the icing on the cake by shorting right into yesterday's high opening, they truly felt clairvoyant and proud. They navigated everything perfectly, didn't they? You know me, I like to say bulls make money, bears make money, but hogs? Those who stayed short were pigs, plain and simple. And today they went to bye-bye, Hormel. Third lesson, the president likes, he loves drama. He's going to love drama for his whole darn presidency. That's one constant from his first term. So all those talking heads who come on endlessly and say, oh, we need certainty, will you stop already? I sympathize, but you're not going to get any certainty from President Trump. And hoping for it is, at this point, frankly, kind of nuts. Say what you will about Trump. He'll never allow his presidency to become boring. We'll just turn it off. Fourth lesson. We want so much to count out certain once-loved stocks, don't we? And maybe someday we should. But when you bet against really good companies like NVIDIA or Apple or Microsoft, you have to recognize that these companies didn't just get to their status by being a bunch of fugazis. Oh, and if you do hate them, sell these stocks when they're up, not when they're down. I give you permission to sell them tomorrow if you really want it. See you later. Final lesson. Let's understand what we do. We're not money managers talking about blowout munis and the big basis trades. We're not trying to get a job with billionaire hedge fund managers. We're common sense people who are conscious of the fact that all of your typical gains for a year occur on an average of 7 days. Today was one of those 7 days. And you had to be in it. You had to own stocks to win. What does this rally off the bottom tell me? It says that if you continue to be too jaundiced, you're going to miss a decent opportunity. As you know, I run a charitable trust, and I can't scout for points. I'm not a trader, at least not anymore. But there have been large enough declines that I need to be open-minded. My history with the president is that while he's striding on fair trade, just like me for what that's worth, at the end of the day, he's actually not trying to destroy the economy. He doesn't want to ruin your IRA or your 401k. So if he's doing something that's laying the stock market to waste, eventually you have to figure that he will change course. And he did. At moments like this, highly emotional moments, I like to do something that most people don't want to do. I go to totems, things that have worked for me for so many years. As I've mentioned before, the measurement that's helped me immeasurably the most is a thing called the S&P Oscillator. That's brought to you by a company called Market Edge, which has a special relationship with the CBC Investing Club. That oscillator hit an extreme reading yesterday, -10, which shows a tremendous amount of selling pressure and despair. Too much. By way of contrast, 0 equals equilibrium, +10 on the other end shows that there's too much optimism. So I checked in with my friend at Market Edge to confirm what happens after this degree of selling occurs, after you get to -10. And I thought his feedback was most relevant. In the last 17 years, the oscillator has hit -10 only 12 times. 10 of those times, the S&P 500 was up an average of 2.7% over the next 30 days. If we go deeper to look at those two outliers, the first one was August 5th, 2011, when the oscillator hit 10.02. 30 days later, the S&P was down 2.12%. Now, that was a bear market. It was caused a 19.3% correction. We had two concurrent crises back then, our debt ceiling crisis, which caused a ratings downgrade of our nation's bonds, and a European sovereign debt crisis. Both were subsequently resolved, though, and you really never heard from them, and the market went straight up. The oscillator hit -10.25 on February 27, 2020. Remember that date? Right as we realized COVID could be a problem. 30 days later, we were down 11.71. Well, automatically, that only fell to March 18th. But 30 days later, we were up 16.74%. But unless you think a pandemic is about to shut down the entire economy again, 2020 really isn't much of a precedent, is it? So let me give you the bottom line on this, one of the most exciting days of our lives. I don't think that things are all that difficult. They're not COVID difficult. Now, I think that you're dealing with man-made crises. It turns out that one of these man-made crises was easily reversible, as we've said over and over again and told you that. When you see stocks in the blast zone rallying, it pays to realize that good things, not just bad things, can happen too. Why don't we start with Bob in South Carolina, please, Bob?
Hey, Jimbo, how you doing, buddy? You're looking good.
Wow, thank you. Well, Bob, I was helped by a really great day, and also by the summit. Please, I want to give a shout out to do a great job for me. What's going on for the whole town?
Yeah,
What's going on?
I'm in limbo here with Merck.
What? What's the matter, Merck?
I own a loan short. I don't know what to do with it. I don't know if I should sell it, hold on to it.
You know, first of all, you're not alone. St. Merck, as we used to call it, has turned into just a complete nightmare. I think that if you buy Merck at a 4% yield, though, you're going to do well. It did touch 76 today. It's back to 81. I feel for what you're doing, Bob. It is remarkable how poorly this stock acts. I do want you to stay the course with it right at this point. And I'm sorry, because it has been a real tough one. Why don't we go to Anthony in my home state of New Jersey? Anthony.
Booyah. How are you doing, Kramer?
Anthony, I'm fine.
I'd like to ask you about Honeywell at these levels with its upcoming split in the end of 2005 and 2006.
Jeff and I talked about this endlessly. up 16 today, by the way. We think the stock is dramatically undervalued. We think that Vimal Kapoor is doing everything right. We could not believe how low the stock got. I am a firm believer and a buyer of Honeywell, even at these levels. Yes, I like it that much. It was down 8% last week. That's nutty. You know what? Why don't we take one more? Why don't we go to Eli in Illinois? Eli.
Hey, Jim, I want to know if the stock Rivian is a buy, sell, or hold with the tariffs. They assemble their own cars.
Okay, listen, go test drive one, don't own the stock. I really don't have that much more to say about it because I do think that they went through so much money that it is daunting. How about that? Daunting is a nice word. I'm looking at my research director, and he knows when I say daunting, what I really mean is horrible. Can I speak to Lynette, please? The land of enchantment, New Mexico. Lynette.
Hi, Jim. Okay, what a crazy ride, right? Well, what I'm doing is I'm calling about FedEx, and I actually have two questions. Okay. Buy the dip. Number one is buy the dip now or wait until May 9 when they report. Second question is how do you think the spinoff is going to affect the company? I also own plenty of UPS, so I don't want any more of that.
I don't like UPS. I think that Raj Subramanian is doing a fantastic job in a very difficult setting. Obviously, we've got all these tariffs. It makes his job 10 times tougher than I know that we ever thought that it would get to. I think you should. The stock was up 10% today. I can't ever tell someone to buy a stock that is up 10%. I do think that FedEx is a very, very good company. All right, look. Things are still difficult. I'm not going to minimize that. But when you see stocks rallying to this degree, remember, the best day for the S&P since 2008, well, it pays to realize that good things can happen, but you have to stay in to win. And stop turning us off because it's a bad day. Oh, man, tonight, I'm giving you my playbook after today's historic rally. First, what's behind the big surge in Treasury yields? We've noodled about this. I'm sharing my thoughts about what's sparking the action. Then, can the rally in gold continue to shine? I like gold. We're going to go up the charts to see if history can repeat itself, and it doesn't sound good. Later, private equity stocks have pulled back dramatically. Is it time to take a look at them, or you have to be like this when you look at them? I'm outlining the reasons why the cohorts decline. And if now's the time to buy, well, why don't we do this? Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
The next series of the world's first downside-protected Bitcoin ETFs with 100, 90, and 80% protection levels through our proven protection strategy. Count on us today for tomorrow.
Your record label is taking off, but so is your sound engineer. You need to hire.
I need Indeed.
Indeed you do. Our advanced matching helps find talented candidates so you can connect with them fast. Visit Indeed.com/hire.
The average dog only lives to be 10. That's 10 birthdays, 10 first summer swims, 10 annual camping trips. At the Farmer's Dog, we don't think that's long enough. That's why our freshly made food comes pre-portioned, just for your dog. Because a dog at a healthy weight can live a longer, happier life.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
CNBC. Live ambitiously.
I'm Dr. Shannon Klingman, the inventor of whole body deodorant like Mando. It's clinically proven to block odor all day and controls odor for 72 hours. Mando's unique formula stops odor before it starts. That's my secret to better odor control everywhere.
Guys, got hair loss? I know what you're thinking. Should I shave my head? Comb it over? Wear a hat? Just stop. This isn't 1970. Keep your hair and your confidence because Bosley, America's #1 hair restoration experts, can give you your real hair back permanently. Check them out because they're giving away an absolutely free information kit and a free gift card to everyone who scans this QR code. Dude, you don't have to look like your dad because this isn't your dad's hair loss treatment. People all over the country trust Bosley because they're ahead of the curve. They use the latest technology to give you your real hair back. And the best part, Bosley's permanent solution is protected by the Bosley Guarantee. Let them show you for free how awesome your hair could look with an absolutely free information kit and a gift card for $250 off. Scan the QR code. Don't wait. Scan the code now and ask about the Bosley Guarantee.
As the stock market bounces back hard after the president's 90-day pause for most of the new tariffs outside of China, we got to talk about something crazy that's happened over the last couple of days. It's a sudden aggressive surge in Treasury yields. I'm betting it's one of the more important reasons why President Trump shifted course on trade. Just look at the yields for the longer-term Treasury bonds. The benchmark for 10-year note has climbed more than 30 basis points from 4% at the end of last week to 4.3%. Now, that is a very big move, people. The 20-year yield has risen from 4.44% to 4.79%, and the 30-year yield is up from 4.41 to 4.75. You usually don't get these really, really big moves. They don't sound big, but trust me, they are. And that's after rates ultimately calmed down a bit today, pulling back meaningfully from their highs. If you look at the 10-year, it spiked all the way to 4.51% around midnight last night before pulling back today. This is not really what's supposed to happen at times of stress for the stock market. The action we saw late last week, really for the past several weeks, is what's supposed to happen. When stocks are tumbling and the VIX, that's the CBOE Volatility Index, is on the rise, investors typically pile into treasuries and other safe haven assets like gold as part of what we call a flight to quality trade. They buy bonds, and when bond prices go up, their yields go down. For example, from February 19th, when the S&P 500 peaked, to last Friday, as S&P 500 fell over 17%, the 10-year yield fell over 50 basis points, from 4.5 to 4.0. Again, that's normal bond market behavior, and it does typically take that long. But this week, the stock market was very weak until today, and Treasury yields still soared. On Monday, when the 10-year yield went from 4.0 to 4.19, even as stocks mostly went lower, investors and market watchers said, I mean, that's odd. On Tuesday, when we had a brutal intraday reversal from big gains to more losses, and the 10-year still jumped another 11 basis points to 4.30, we started to hear people wonder what the heck is going on here. And after last night's spike above 4.5%, we can no longer ignore this move. Remember, bonds are bigger than stocks, okay? So what's driving it? All right, here's what we know for sure. Someone is selling treasuries in significant size. That's why the yields are going up. Treasury prices move in the opposite direction of yields. So when there's significant selling, the yield goes higher. We don't know for sure who's doing it. No one puts a name on it. Originally, some thought it was the Chinese as part of their response to Trump's now 100% plus tariffs. After the Nikkei got crushed earlier today, some thought it might be the Japanese. By the way, they happen to be the world's largest holder of treasuries. They have $1 trillion worth. But by last night, as the 10-year yield was screaming higher to 4.5%, a new consensus culprit had emerged. It was the basis trade that was blowing up and causing all of these problems. What is the basis trade, you ask? You heard it all day. Don't worry. You're not alone. This is kind of like last August when suddenly everybody learned it was an instant about the yen carry trade that blew up and caused a sharp sell-off for stocks. Just like the yen carry trade, the basis trade is a needlessly intimidating name for a simple idea. Hedge funds are betting that the difference in price, called the basis, between regular treasuries and treasury futures contracts with similar characteristics will shrink as the futures contract approach expiration. That's natural. To make that bet, they buy cash treasuries and they short the treasury futures contracts. The thing is, the difference in price between treasuries and treasury futures is minuscule. In theory, it shouldn't exist at all, but it does because of supply and demand imbalances in treasury markets and regulatory limitations that prevent other types of arbitrage trading. So because the difference between treasuries and treasury futures is so small, for the trade to really worthwhile for hedge funds, they have to do what is known as lever up. Perhaps as much as 100 times they borrow a huge amount of money if they want to make a reasonable return. Typically, they get their leverage from the repurchase agreement market or the repo market, as is typically known, where broker-dealers provide cash for investors by buying government securities from those investors with an agreement that the investors will repurchase them the next day for a slightly higher price. I know, very convoluted, but when it works well, during normal times, the basis trade works for everybody. The hedge funds make their profits, small, but because they blow them up with debt, it works. The broker-dealers make money by providing the leverage. Even the government benefits because the basis trade provides liquidity for treasury markets. But during periods of turmoil, well, things can get pretty problematic. Mostly because hedge funds have money locked into this basis trade, and they suddenly need that money elsewhere. Or perhaps because the broker-dealers that provide the leverage need the money back. When that happens, the trade is unwound. They have to undo the whole trade quickly. And the way that it's unwound is by selling treasuries. Remember, I told you somebody's selling treasuries, and using the cash that was raised from the sale to buy back the treasury futures that have been sold short. But notice the first part of that process, the selling of treasuries. That's where the pressure comes from. There's a bit more to it than that, but these are the salient points. And based on the information we have, including the fact that so much action happened overnight last night, when much of the repo market activity is actually taking place, it seems like this is one of the periods of turmoil where many of the basis trades out there are being unwound, meaning there's forced selling of treasuries happening all over the place. Hence the decline in price and the rise in yields. Somebody got hurt real bad. So, is it the unwinding of the basis trade that's creating all this noise in the treasury market? Yes, that's probably a big part of it. But you know what? I wouldn't be surprised at all if the Chinese are indeed selling some U.S. treasuries, too. And maybe investors are simply selling treasuries that they panic bought during the sell-off last week. Now, I don't want to dismiss the sharp uptick in treasury rates entirely. If it reverses quickly, then it's not really a problem at all, except for the hedge funds that are taken out on a stretcher after getting too cute and too complacent from this form of leverage arbitrage. But if this is extended, it's going to be a real problem. Short-term, higher treasury yields make it harder for the Fed to start cutting rates. Longer-term, higher treasury yields mean higher borrowing costs for the country and compounding debt problems. I'm not going to panic here about the weird move in rates this week, especially now that we have the 90-day tariff pause outside of China. I was very heartened to see that. A rather large $39 billion offering of 10-year treasuries went very well today, indicating there's still demand for treasuries at an attractive price. You want that. We don't want rates shooting up here. That would be wrong. That would be bad. But here's the bottom line. There's been some counterintuitive action in treasury yields this week, with rates spiking due to elevated selling in treasuries, even though rates should normally be going down. It's something to keep an eye on, but for now, it appears to be due to some weird quirks that should fizzle out as we return to a more normal market environment. And with this 90-day tariff pause, I think we're well on our way. Mad Money's back after the break.
Coming up, is the rally in gold losing its luster amid the recent market volatility? Cramer's going off the charts and seeing if now is the time to invest in gold. Next.
So many in this business try to scare you. We try to give you the confidence to do it yourself.
By joining the club, it gave me more confidence in my investing decisions.
There's just a huge reservoir of information available. You couldn't ask for more support.
It just is a game changer because you can feel confident through the highs and the lows.
The club creates confident investors no matter what the climate.
Get invested. Join the club today. Go to cnbc.com/join Jim.
Epic Universe, only at Universal Orlando Resort.
Good morning with Vocalax.
Good morning. Yeah.
Try Vocalax Chewy Fruit Bites for fast and gentle constipation relief in as little as 30 minutes. Making your good morning even better with Vocalax.
Release the hounds.
Puppy monkey baby.
I'm on a porch.
This is the way we take it.
Groceries are here.
Thanks, babe. You get the milk?
After last month's massive solar flare added a 25th hour to the day, businesses are wondering, what should we do?
I'm thinking company-wide power nap.
Anything can change the world of work. From HR to payroll, ADP designs for the next anything.
Hello, everyone. I'm Julie Sweet.
Welcome to another edition of Reinvented with Accenture. Today is a very special episode. Normally, we're talking about reinventing a company. Today, we're talking about reinventing a country.
Payments have to be fast, they have to be secure, they have to be convenient, and they have to be inclusive. Those are things which are not negotiable. And when you think about it, there is no single commercial transactions which doesn't rely on a payment at some point.
My wife Gina was born to be a chef. Exploring new foods is her passion, but diabetes threatened to take that all away. Then Gina got Dexcom G7. Now she can see how food affects her sugar levels in real time. With Dexcom G7, she doesn't have to choose between the foods that she loves and her health. I can't wait to see what she creates next.
You know it's gonna be good.
Look at this one under-eye bag. It's gone.
They are some of the hottest videos on social media. Those videos claiming to instantly get rid of bags under your eyes. It's called Plexiderm, and lifestyle expert Annette Figueroa is here to tell us why she says this one is for real.
This one is for real, and I'm so excited. And not only does it work on the bags, it works on the appearance of crow's feet, fine lines, and wrinkles.
At our $14.95 price, your solution is at plexidermtrial.com.
The stock market came roaring back thanks to President Trump's 90-day tariff pause. But what does that mean for the one asset class that's been holding up just fine? Gold. Is it possible the gold rally has gotten ahead of itself? To answer that question, we're going off the charts with the help of Carly Garner, a terrific technician who's the co-founder of DeCarly Trading, the author of Higher Probability Commodity Trading, and, of course, our resident commodities expert. When it comes to gold, she thinks that the gravy train has probably left the station. In fact, compared to most other assets, especially silver and treasuries, she says it looks pretty darn overvalued. Making matters worse, lots of money managers and home gamers are already long gold, and these people are wildly bullish. You never want too many bulls because it means there might not be many people left to buy whatever you're trying to have go higher. In fact, Garner points out that there was recently a Firestorm 1X mass accusations of market manipulation when gold retreated modestly on Friday. For Garner, this is a textbook sign of frenzy. Frenzy always ends badly. As she sees it, gold is not a magical metal that automatically goes up in times of chaos. It's merely an element, a periodic table, that happens to be a bit more challenging to mine because it comes in small chunks. It's not necessarily scarce, though, nor is it liquid, nor is it all that useful to manufacturers. At the end of the day, gold's pretty, but it's not entirely practical. The fact is, if you want to own a stockpile of real gold, it's a huge pain in the neck. For Garner, there are times when gold works and times when it doesn't, just like any other commodity. And right now, she says that gold hasn't been this overbought, therefore overvalued, since the summer of 2011. Ooh, that's when the debt crisis occurred. Back then, the precious metal pulled back 45% from its euphoric highs. If Garner's right and we see a similar move here, that could take us down to $1,650 an ounce. I mean, we're more than $3,000 today. Take a look at this long-term chart. This is a monthly chart of gold. Sorry, right here. Versus the SP 500. According to Garner, gold is a great diversifier. It goes through periods of correlation and then non-correlation with various assets. In other words, sometimes it moves with the market, sometimes it moves in the opposite way. But in recent years, gold and stocks have moved mostly in tandem. Garner says that's primarily the result of the Fed's easy money policies and too many dollars chasing too few assets. Here's the problem. Given that gold and the stock market have been trading together for years now, you have to worry that could plummet. They could plummet together, too. You know, stock market go down and gold go down. Stocks were the leader on the way up, and Garner thinks they could also be the leader on the way down. If so, the recent breakdown in SP 500 should eventually lead to a similar breakdown in the precious metal. Though, of course, recognize we had a big rally today. Since the thesis is that gold's been trading with stocks and stocks have been falling apart since February, let's zoom in on the monthly chart of the S&P 500 futures. Okay. Following a slow motion divergence between the relative strength index, or RSI, down here, an important momentum indicator, and the S&P, where the RSI was making lower highs while the market made higher highs, stocks finally broke down after Trump rolled out his extremely aggressive tariffs. The April 6th Sunday evening futures low tagged 4832. Okay. There. Just below the 4850 support level offered by the trend line that started in March of 2020. Well, that'd be bad right there. Last night, the same thing happened again. Garner said either the Trump follows charts. I don't think he does, though. Or the charts follow Trump. I think that's probably more like it. But either way, buyers stepped in to buy futures last night on precisely trendline support near 48.50 and managed to close around 5,500, the previous trendline support. For all intents and purposes, this is technically a rejection of the bear market. However, Garner says we are still subject to headline risk and changes in the trade war. If we do head back lower, she would expect 4,600 to be an amazing buying opportunity. But if that was it for the sell-off, then 6,500 is in the cards. Boy, that's back where we started from. The key is to stay safe. Less is more. Now, all right, so now how about the monthly chart of gold itself? Last month, gold ETFs and futures experienced historic inflows. But Garner believes this is an asset that should be bought when nobody wants it, not when everybody wants it. Gold temporarily surpasses trendline resistance near 3,060 per ounce, but it is unusual for the market to color outside of the lines. So here's the number right there. In fact, when gold breaks out and then falls back beneath support, Garner says that generally means you're looking at a confirmed bull trap. The monthly relative strength index right here suggests euphoria is drying up here. See that, right? I buy that. It is drying up, which is what usually happens after big gold rallies get overbought like this one. If this repeats, which is what Garner's betting on, then the gold market could be really shaky. A breakdown below 2,900, well, that opens the trap door. Few expect a complete retracement of the 2024 rally, which would bring the price all the way back down to 2,170. That's hard for me to believe, but hey, that would be par for the course historically. At the end of the day, she says gold rallies have never yet to survive a monthly RSI reading, remember that's the lower one, of more than 70 without some correction. Well, here we are. Take a look. Every time there's been a correction. That's a very good call by Garner, by the way. Now, check out the monthly chart of gold versus U.S. Treasury bond futures. Right now, the monthly spread between Treasury bonds and gold is pretty wide by historical standards. And here you can see blue is gold, and then this mixed color is Treasury. So you see the spread. Again, if history's any guide, it's almost guaranteed to narrow. The million-dollar question is when. Gold and bonds are direct competitors for safe haven investment dollars. One pays interest, the other one doesn't. When rates are high, money eventually moves out of gold and into treasuries, and vice versa. Sadly, rates have been ticking higher this week. Sooner or later, Garner's betting this will be a drag on gold. Let's make it even easier. How about gold versus silver? Take a look at this monthly chart. Normally, these two trade pretty closely together because really the same story. But sometimes one gets ahead of the other. Trade with each other. Right now, buying a single ounce of gold costs about 99 ounces of silver. At the trough in 2011, an ounce of gold would buy just 30 ounces of silver. Historically, the average is around 1 to 70. So 99 means gold is very expensive versus its cheaper counterpart. Garner is betting this spread will eventually narrow because that's what always happened. Back in 2011, silver was the runaway metal, leaving gold languishing in its footsteps. But once the metals boom was over, the spread narrowed, with silver falling faster than gold as they both entered a bear market. This time, Garner's expecting a repeat of this narrowing, but with gold leading silver lower, just as it's been leading the way higher. Let me give you the bottom line of this complex situation. The charge, as interpreted by Carly Garner, suggests that the gold rally will soon lose its luster. If you've made money on the way up, you know what? She thinks maybe you could ching it. I'm a believer in gold and don't want to trade it. But if you are a trader of gold, I'd say take Garner very seriously. Let's go to Mary in California. Mary.
Hello, Mr. Kramer, and thanks for taking my call.
My pleasure, Mary. What's happening?
Well, I've gotten myself curious about a stock called MP or MP Materials. I ran into it on a program within the last.
Right? Did you see him yesterday? He was on. Okay, this he used to come on our program all the time. James Litinsky, and it's had a good run. It's moved up all the way from the bottom, but it used to be much, much higher. My take is this. I think that rare earth specialty materials are going to do well under Trump, and I like Litinsky. I think he's the real deal, but boy, they keep losing money. This is the year that they either make money or I go against them. Period. End of story. Agatha in New York. Agatha.
Hi, Jim. Yes, this is Agatha.
Hi, Agatha. How you doing?
I'm good. I hope you're doing well.
Agatha, today was just a great day because we nailed it. We just nailed it today.
Yes,
we stayed the course and we nailed it.
Yes.
All the scaredy cats, the basis people, they're history.
Good. Well, look, I have an old crystal ball, but lately, as you know, it stopped working. Right. But today it is working again, so I'm happy. In the meantime, I have done relatively well with Chevron. Should I keep it?
Yeah, definitely keep Chevron. It's got 4.6% yield. It keeps buying back stock. You saw the way it bounced off the bottom today. It closed up 9. I think Mike Wirth's doing a terrific job. The only problem I would tell you is I am not a bull on oil, but you came to me and you wanted an oil, and I come back and I say, if you want an oil, then I like Mike Wirth. I like Chevron. All right, listen to me. It was a very hard set of charts, but you get the picture, right? Charts interpreted by Carly Garner say you got to sell gold. All right? It's losing its luster. I think the call is worth seriously paying attention to only if you're a trader. If you're a gold person like me who doesn't want anything to that, just hold it all the time, then just don't do a thing. More Mad Money ahead, including my look at what's behind the pullback in private equity before today's rally. Then I'm taking a step back from today's tape and breaking down the longer-term stories about what I think we should be watching. And order calls rapid fire tonight's edition of the Lightning Round. So stay with Kramer.
A Squawk Box exclusive. Amazon CEO Andy Jassy. The state of the consumer. AI strategy. And Amazon's response to Trump's tariff policy. Stay ahead of the market. Squawk Box. Tomorrow, 6 a.m. Eastern. CNBC.
Something amazing is happening here. Teams have more power to withstand outages. That's because CDW Solutions architects are building more resilient IT and electrical infrastructures with Schneider Electric. With EcoCare remote monitoring services and 24/7 support, your organization has the power to do more than keep the lights on. Make amazing happen. Schneider Electric and CDW.
Some people like doing things the hard way, like doing their finances with a spreadsheet instead of using Quicken. Quicken pulls all your financial info together in one place and updates it automatically. How easy is that?
Yoo-hoo! No. That is against the HOA bylaws.
Bylaws, my laws. We're showing where Consumer Cellular gets great coverage.
You're making everything orange.
I know, right? We use the same towers as Big Wireless, so you get the same coverage. Difference is, our plan started at just $20.
No, that can't be true.
But it is.
Wow. Well, I hope you're using Primer.
Do we use a primer? For unlimited talk and text with reliable coverage and your second month free, call Consumer Cellular.
My UTIs were a recurring nightmare.
For the both of us.
Then we found support with Eucora. Eucora has UTI relief products and science-backed supplements that offer a proactive approach to urinary health. I finally feel free. Try today at eucora.com.
At Morgan Stanley, old school hard work meets bold new thinking. Partnering to unlock new ideas, to create new legacies, to transform a company, industry, economy, generation. Because grit and vision, working in lockstep, puts you on the path to your full potential. Old school grit, new world ideas. Morgan Stanley.
Inflation and economic uncertainty have affected all of us. But if you have a structured settlement or annuity, J.G. Wentworth can help you get a lump sum of cash now in exchange for some or all of your future payments. J.G. Wentworth has helped individuals get over $290 million in the past year alone. So why live month to month in these uncertain economic times? Call J.G. Wentworth today at 877-CASH-NOW and get the cash you need now from your structured settlement. Call now.
You've got a glow about you. inside and out. Show it to the world with just 10 Omnilux Contour, an LED light therapy mask clinically proven to reduce fine lines and wrinkles. Find out how you can improve your skin at OmniluxLED.com.
With the 90-day pause on tariffs we got from the president today, we now have some real breathing room. But that doesn't mean the tariffs are off the table. It just means we got some much needed time to adjust. Still, now that the averages are roaring as Wall Street declares victory, I think it's worth going over the stocks that were absolutely getting killed until a few hours ago. Now, some of these were very obvious, but some others snuck up on us, like the private equity stocks. I mean, before today's rebound, most of these had pulled up back more than 40 or more from their highs, 40%. And those highs were just set in the past few months. I mean, so what the heck do we do with these? All right, private equity firms in public markets are a relatively new thing over the past 20 years. Blackstone, by far the largest in the group, is the most seasoned, having come public back in 2007. Apollo came public in 2011, Ares in 2014, KKR in 2020. And they've all put up some excellent gains in recent years, until the last few weeks. Blue Owl and TPG only came public in 2021 and 2022, respectively. But after getting through the lean year of 2022, they both had nice gains over the past couple of years. These are very attractive stocks. That's the common thread amongst these private equity firms. Huge gains over the past 2 years. Over 2023 and 2024, these stocks all more than doubled. KKR more than tripled. And then they fell apart once the stock market started plummeting on tariff woes. So what the heck happened here? Simple. Private equity firms did great when the economy was growing steadily, while with low unemployment and a strong stock market, they caught fire at the end of last year as investors thought the Fed would keep cutting interest rates. Remember, private equity firms borrow money to take businesses private, so lower rates save them a fortune. Then came the election, a Republican sweep, and the immediate assumption was this would be fantastic for the private equity business, with a much better deal-making environment and a better IPO market. These firms need that because they either ring the register by either selling to other companies or bringing their portfolio companies public, like right here. And that's why these private equity stocks roared to new all-time highs in November, December, January, and even early February. But they didn't get what they were expecting. First, the economy soured. That was happening even before the threat of tariffs emerged, with some soft data for January and February. Initially, it wasn't clear if that was due to bad weather in January or other quirky factors, but eventually it became clear that the macro environment has worsened. Then we learned about these high tariffs, and things just got worse. A grim picture. While the consensus entering this year was for GDP growth of somewhere around 2% in the first quarter, the Atlanta Fed's real-time tracker, which I look at all the time, is currently predicting something in the negative 3% range. Even after adjusting for elevated gold imports this year, it's still around negative 1%. Now, bad economy is bad news for private equity. As for the idea of lower interest rates, well, we started losing that leg to the story a while ago. Really, back in December, when some bubbly inflation numbers caused the Fed to pause its rate cutting and say that it would sit on its hands for a while. That's part of the reason why some of these private equity stocks topped out in late November, early December. When we got even more hot inflation readings in early 2025, expectations for rate cuts came down significantly. Bond yields only started coming down again pretty recently, and for the wrong reason, because investors are now betting on a recession, for heaven's sake. Although in the last few days, those bond yields started going up again, a real bad sign, and possibly one reason why the Trump gifted us with this 90-day pause. I heard that a lot today. I don't think it's the case, but I have to put it out there because it was in the air. Finally, remember that expectation for a more pro-business White House? Let's say that just hasn't quite materialized yet, although today was certainly a step in the right direction. President Trump's implementation of much higher than expected tariffs on essentially all imported goods has terrified the market. Hence the need for this pause. Originally, it was the 25% tariffs on goods from Mexico and Canada and an additional 20% tariff on goods from China, ostensibly to get them to crack down on fentanyl trafficking. Though really, because the president seems to really like tariffs to those who have a big surplus against us. Then came the 25% tariff on all imported automobiles, and that was all before Liberation Day, when the draconian, not-so-reciprocal tariffs were imposed on essentially all imported goods, even those coming from the uninhabited islands just off of Antarctica, where apparently there are penguins that are very happy. Now, after some tit for tat in the week that followed, we're looking at massive tariffs on goods imported from China. Thankfully, we got this 90-day pause on most tariffs, which is what allowed everything to just percolate today. But the tariff on goods from China just got up to 125%. Wow. But needless to say, people investing in private equity stocks now have a lot less faith in the Trump White House than they did coming in. The M&A market's been horrendous. According to data from DealLogic, U.S. M&A volume declined by 13% in the first quarter, with the number of deals falling 24% year over year. That's horrible. The issue, of course, is the president's tariff agenda, because nobody wants to stick their neck out to make an acquisition when it's unclear exactly what exposure the companies in question will have to these tariffs. And by the way, I expect it to continue, even the 90-day pause, well, because we have no idea what the final policy will look like, do we? In the end, nobody feels confident about deal-making here, which makes private equity firms, well, they're not going to be able to sell their portfolio businesses to new owners. It's going to be troublesome. Same with the IPO market. CoreWeave barely made it through the IPO window. They nearly lost a couple of fingers as it slammed shut just behind them. Now, two of the next largest deals for buy now, pay later contenders, Klarna and ticket exchange StubHub, have officially been shelved. And again, don't expect that to change until the market calms down significantly. Today's rebound is not enough. If the M&A market's dead and the IPO market is dead, these private equity players, they just can't ring the register. So, I would say they're kind of stuck. The monetization of existing investments will be delayed, which in turn means the firms can't redeploy funds into new investments. That means none of them are able to take advantage of the recent sell-off, or the PE firms will still go through with their planned exits, but at much lower valuations than they were hoping to get, hurting their returns and make it harder to retain their investors or attract new capital. It's suddenly a very sticky situation for private equity, just a few months removed from a period when things all seem to be unfolding so nicely for them. Here's the bottom line. There's no shortage of damaged group of stocks these days, are there? But one of the most shocking declines to witness has been the overall downfall of these private equity firms, which seemed totally fine a few months ago. Fortunately, this 90-day tariff pause has allowed the stock market to roar, and the PE stocks led the way today. But I think an awful lot of things have to go well in order to reverse the negatives here. And one good day does not a private equity bull market make. Mad Money's back after the break.
Coming up, Kramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
Volatility and breaking news can impact your portfolio. Club members get access to strategies in real time, so they can make investment decisions without panicking.
Get invested. Join the club today. Go to cnbc.com/join Jim.
Did you know taking Zysol at night relieves allergies while you sleep? So you wake refreshed for a more productive day. Get 24-hour continuous relief that does not fade. Be wise all, take Zysol at night.
I'm certain it's level 5.
Are you for imprint certain?
I'm certain it's level 5.
Certainty matters, like the certainty of 4imprint, your home for high-quality promotional gear, including exclusive items and brands they love, printed perfectly and guaranteed to arrive on time. To wow your clients, nail your next event, or inspire your team, check out 4imprint.com.
4imprint, for certain.
Only ServiceNow connects every corner of your business, putting AI to work for people.
Every corner?
Every corner, Nick. So Kate in HR, hey Kate, can focus on people, not process. Patty in IT is using AI agents to deal with the small stuff so she can work on the big stuff. AI helps Jim solve customer problems before they're problems.
Oh, so we all work better together.
My work here is done.
Excuse me.
Which way back?
When we started feeding Buggy, the farmer's dog, he lost so much weight. Pre-portioned packs makes it really easy to keep him lean and healthy.
In the morning, he flies up the stairs and hops up on my bed. In the past, he would not have been able to do any of those things.
The next series of the world's first downside-protected Bitcoin ETFs with 100, 90, and 80% protection levels through our proven protection strategy. Count on us today for tomorrow.
SailPoint is a case study in reinvention, driving innovation to find new ways to protect customers and to help them thrive in volatile and unpredictable times.
SailPoint has a clear vision of how we can help enterprise customers secure their enterprises through the lens of identity. We're excited about returning to the public market, but it's not a finish line. We're going to keep going and continue to make a major impact on this industry.
We're sitting ducks, waiting for them to infiltrate our defenses. Millions of tries, and they're in. Uh-oh, this one's in the code.
Lightning Round is sponsored by Charles Schwab. Trade brilliantly.
It's time! It's time to light around Craig Bradford. Rolling in the stock center. Buy, sell, so sell, dominate the 7% of the way you play this out. And then the lightning round is over. Are you ready? Ski deck to light round Craig. Let's start with George in Arizona. George.
Big old wacky Wednesday booyah to you, Jim. George in Arizona.
Betcha. Oh, yeah, George in Arizona. Speak to me. Speak to me.
I am looking at a company that should be participating in the natural gas move up. High dividend payer, dropping debt, new CEO coming on. The company, symbol FLNG, Flex LNG.
But don't you think that it should have already made it by now? I mean, the stock just does nothing but go down during the greatest revolution of all time. I'm going to have to take a hard pass on that one. I'm sorry, George from Arizona. Let's go to Brandon in Kansas. Brandon.
Hey, Kramer, how you doing?
I am doing well, Brandon. How about you?
Pretty good. I'm new to investing, Kramer. I'm rookie investor here, and I want to enjoy my stay in Kramerica.
I like that. I'm glad you're here.
I'm an employee at Mercedes-Benz here in Kansas City, and we made major cuts this week. So I was wondering, would the used car industry be a good look for my portfolio? So I'm looking at KAR, Open Lane, and I want to open it.
KAR is a really, really good company. And because you are so kind and new to investing, can I just say that Carvana is real good, too? We like Carvana in the single digits because I bought one and didn't like it. I tossed it back. Great company. Let's go to Ian in Florida. Ian.
Booyah from Florida, Jim.
Man, good to have you on the show. I don't know what part of Florida. I lived there for a while. I love it. What's going on?
Oh, down here in Miami Beach.
Oh, so great. So great. We like Delray, too. All right.
Yeah. Third-time caller, investment club member, of course.
Yep.
And
Thank you.
What a great day today, Jim.
It was a good day for those who stayed the course. It was a really lousy day for those people who exited. Bye-bye.
I totally agree.
Yep, thank you.
Jim, I'm looking at a utility play that's well off its 52-week high of $199. It's VST, Vistra. What do you think?
Now, see, I never really cared right now, honestly, for the energy trade, because then Microsoft will say that it's closing a data center. No one will like the group. So let's stay away from the energy trade. It's too much second derivative, so to speak. Let's go to Jordan in California. Jordan.
Hey, Jim. Thanks for having me.
My pleasure.
Hey, last time I was on the show, you mentioned Hims and Hers was a sell at about $5 per share. Since then, I've built
contraire, Monfrere, I actually reiterated to sell at about 50 or 60 and never said it was at $5. I'm going to have to take another call because that's not correct. Oh, no, I hate to leave on such a downer moment, but I guess that's what we have to do, an otherwise up day. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, after a day of wild market swings, is now the time to get back into chip makers like NVIDIA? Kramer's giving you his take and breaking down what today's gains mean for the AI space. Next. Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
I would point out it was 9:51 before you mentioned the word NVIDIA. It's a new record.
Do you remember the old days?
Congratulations.
Yeah, the old days.
I miss the old days when you'd mention...
Really?
You'd mention that instead of Peter Navarro.
I got 2 words for you. Be cool.
It all starts at 9 a.m. Eastern.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Thirsty, headaches, fatigue, irritability. Transform ordinary water into extraordinary hydration. Get more out of your water. Tear, pour, live more. Liquid IV.
Hello, everyone. I'm Julie Sweet. Welcome to another edition of Reinvented with Accenture. Today is a very special episode. Normally, we're talking about reinventing a company. Today, we're talking about reinventing a country.
Payments have to be fast, they have to be secure, they have to be convenient, and they have to be inclusive. Those are things which are not negotiable. And when you think about it, there is no single commercial transactions which doesn't rely on a payment at some point.
Gold Bond believes touch says everything. It says, I see you. I feel you. And I know you. Gold Bond. Get in touch with irresistibly touchable skin.
Do you have a life insurance policy you no longer need? Now you can sell your policy, even a term policy, for an immediate cash payment. Call Coventry Direct to learn more.
We thought we had planned carefully for our retirement.
But we quickly realized we needed a way to supplement our income.
Our friends sold their policy to help pay their medical bills. And that got me thinking. Maybe selling our policy could help with our retirement.
I was skeptical, so I did some research and called Coventry Direct. They explained life insurance is a valuable asset that can be sold.
We learned we could sell all of our policy or keep part of it with no future payments. Who knew? We sold our policy. Now we can relax and enjoy our retirement as we had planned.
If you have $100,000 or more of life insurance, you may qualify to sell your policy. Don't cancel or let your policy lapse without finding out what it's worth. Visit CoventryDirect.com to find out if your policy qualifies, or call 1-800-514-7800. Coventry Direct, redefining insurance.
Damon, you are a great dad.
You've been following me. This and not like this. I have a stroke. This can be warm to the plug. You know what I'm saying? Hit me up later.
Shark Tank, coming up next. CNBC.
When breaking news of market volatility affects your portfolio, we are there for you so you don't panic.
I can stay grounded in the portfolio versus making irrational emotional decisions based on what the market might be doing.
Go to cnbc.com/join Jim.
Let's talk fundamentals for a second, because even after we just had this whamma-jamma short squeeze, there were some things that really were going awry, and those things matter. We got to address them. First, 3 weeks ago, we were at NVIDIA's big trade show, and we heard one of the greatest stories of all time, the build-out of data centers that are needed in order to handle all of this artificial intelligence functionality. Now, though, 20 days later, there's a belief that the data center El Morte is dead, because Microsoft has shaded down some demand for some of the latest and greatest NVIDIA chips, and now there's really no reason to own NVIDIA, they tell us. In fact, until around 1 p.m. today, the prevailing belief was that the most risk-free trade, besides shorting Apple, of course, was betting against NVIDIA. As for CEO Jensen Huang, he was terrific, but you know what they say? He's had his day in the sun. To me, NVIDIA now has a chance to change the narrative. Yesterday, Adam Jonas, the James Joyce of analysts, don't laugh, that guy holds up, penned a piece about robots. I happen to have introduced myself to one of the robots when I was at GTC. He was one of those real hail fellow, well-met kinds of characters, kind of foppish, clubby. You remember them in college. We're talking about someone who can clear the table, do the dishes, sweep the floor, wipe the spills with total aplomb, a total marriage saver at that. This robot is a magnet for NVIDIA chips. So if Microsoft doesn't want its chips, I believe that 1X Robotics, the robot's parents, will take as many as it can get. If 1X is going to manufacture these things at scale, it'll need to have as many of NVIDIA's chips that Microsoft will give it. Jensen told me I can expect to be able to rent one of these robots real soon because I can't make good hospital corners. And if I leave so much as a spoon on the table, it's grounds for divorce more quickly than when I poke fun of my wife's Baconator obsession. I hope Microsoft saves my marriage by giving 1X all the chips it needs. Please, Satya, please. The gating factor for these robots, not enough NVIDIA chips. Yesterday, I signed up for Perplexity, adding to my collection of Grok, which I love, ChatGPT Pro, Gemini, take that Google search, Meta AI, and Claude. Now, that's a lot of bots, a lot of competition. And you know what I say? Whoever has the largest number of NVIDIA chips wins. I hope Microsoft will let these other companies get the chips they need. I spent a lot of time with CoreWeave in the last few weeks, and, oh, yeah, you may not like their debt. You may like their Jersey attitude. Give me a break. I love them. But the seriousness with which they're building out the data centers, it's real. What's their biggest gating factor? Again, not enough NVIDIA chips. So yes, Microsoft's wavering. Ever since the Chinese unveiled DeepSeek, NVIDIA's been in a rut. True, Jensen met with President Trump last week, and the president agreed that NVIDIA can keep shipping their NVIDIA Lite chips to China. Nobody even noticed. So many obituaries. Who can see from underneath them? But what matters more than anything else is that despite Wall Street's near universal belief that NVIDIA's best days are now behind it, despite the largest hedge fund selling it hand over fist, as long as NVIDIA's chips are sold out as far as the eye can see, yet its stock sells at 25 times this year's earnings, I want to be a buyer. You can't go from being king 3 weeks ago to pawn this morning. Maybe in reality, NVIDIA's just a rook, but I'll pay 25 times for rook's earnings any day of the week. Like I said, there's always a bull market somewhere. I promise I'll find it just for you. Right here on Mad Money, I'm Jim Cramer. See you tomorrow.